In this our revision session, let us start with another standard, Ind AS 19. That is nothing but employee benefits. The points that we should ponder upon is the coverage, scope, I can say, short-term employee benefits, long-term employee benefits, then you need to remember retirement benefits, and last, termination benefits. Let us quickly revise all those points pertaining to Ind AS 19. Now, my dear students, the first area, that is nothing but scope, or you can say coverage. It is very clear that the Ind AS 19 does not deal with employee benefits covered by Ind AS 102, share-based payments. Same way, this does not deal with accounting in the books of entities that manage employee benefits. Okay, so this is all about our coverage. Now I move on to what are employee benefits, friends. If I would like to divide this employee benefits, this employee benefits can be two parts, nothing but paid during service and paid post employment. Now, the employees benefits which are paid during service, there can either be short term employee benefits or that can be long term employee benefits. And if it is paid post employment, we can bifurcate it as retirement benefits and termination benefits. Now let us understand one by one each of those benefits, and this is all about our chapter. The second point, short-term employee benefits. What are short-term employee benefits? Short-term employee benefits are those employee benefits which fall due wholly within 12 months. After the end of the period in which employee renders the service. So, if the employee has rendered a service in a particular period, it will wholly fall due. Due in the sense, here I mean to say settled. Due for settlement within 12 months from the period in which the services are giver. Now, what can be our short-term employee benefits? Very simple. The short-term employee benefits can be salaries, wages, leave encashment, profit sharing plan, bonus plan, and so on. Now, as far as salaries, wages is concerned, what does the standard say in case of salaries and wages? The standard says recognize expense or asset, as the case may be. Recognize liability if not paid. Recognize asset if paid in advance. This is nothing but with respect to salaries and wages. Then comes leave. I'll do the working here. Friends, as far as leave is there, how should it be accounted for? So, for leave, the standard bifurcates it in this way. Utilized during the period and unutilized. During the period. If it is unutilized, within that we can have two bifurcation, that is, you are allowed to carry forward permitted, carry forward not permitted. If carry forward is permitted, within that also further two parts. It is vesting, it is non-vesting. When I say vesting, it means employee can claim cash compensation, and non-vesting means employee can only claim leave. Now, how all these things will be accounted for, my dear students? See, the standard says if the leave are utilized during the year, it means the employee has already taken a leave, then friends, no accounting is required, no journal entry. If it is unutilized, it means the employee has not taken all the leaves during the period. Some leaves will go further in the next accounting period. So, it is unutilized. So, within unutilized, there are further two parts. Carry forward permitted, it will go in the next year. Carry forward not permitted. If it is not permitted, again no accounting. If carry forward is permitted, then what? Sir, I can demand cash compensation that I am going to sell off my leaves, give me my money, cash compensation. Or the alternative is employee will not claim for compensation, he will take the leave. So, the employee is now eligible to take two leaves, leaves which are carried forward from the previous year plus the leaves which have arose in the current year. What is the accounting treatment? Here standard says recognize provision with respect to all leaves outstanding. You will create provision for all leaves. Here, recognize provision for expected number of leaves that will be utilized. Okay, my dear students, so this is all about our leave. Now comes the third area. What is the third area? Very simple area, profit sharing plan or you can say bonus plan. Now remember friends, profit sharing plan and bonus plan does not mean we are sharing the profit. It is nothing but a kind of a variable consideration that we are going to give you variable consideration. This is what it is all about. Your compensation is dependent on profits, your performance, something like that. So here no accounting is to be done separately. It's as good as recognize expense or asset. If allowed to be capitalized under prevailing Ind AS, then we will capitalize as an asset and expense. And same, recognize liability if not paid. Recognize asset if paid in advance. So this is all about our profit sharing plan and bonus plan. So basically under short-term employee benefits, there are three things: salaries, wages, and any kind of perquisites and all those things. Recognize it as an expense. Only if paid in advance, show it as an asset. If payable, show a liability. Then comes leave. Leave two parts. Yeah. Utilize, unutilized. Within unutilized, carry forward allowed, carry forward not allowed. Within carry forward, again two parts. You are allowed to claim cash compensation. You are not allowed to claim cash compensation. And thereafterwards, my dear students, it was profit sharing plan and bonus plan. Now friends, the second area, instead of going for long-term benefits, I'll just go for retirement benefits and then we'll discuss long-term because long-term is similar to retirement. Retirement benefits. Now what are retirement benefits? Retirements are those employee benefits which fall due because of the underlying event of retirement. Now, before I go for retirement benefits, I would like to add up something. There are entities that are going to manage my employee benefits. These entities may be created because of legal structure like EPFO, or it may be a multi-employee plan, or it may be an insurance plan, or that entity would be exclusive entity which is managing the retirement benefits of our group employees. So there are four types of entities who are managing all your employee benefits plan. It can be statutory plan, group plan, multi-employee plan, that is multi-employer plan, and insurance plan. Yeah. So these entities manage our money. For that is required because we have to understand what are these retirement benefits. A retirement benefit can be either defined contribution plan or it can be a defined benefit plan. Defined contribution plan means actuarial risk and investment risk is not on employer entity. Defined benefit plan means either actual risk or investment risk or both is on the employer entity. So now either the actual risk is on you or the investment risk is on you, then it's defined benefit plan. Both of them are not on me, it is defined contribution plan. Now here accounting is very simple. Account for the benefits as expense. Of course, if used, then asset. If amounts are payable beyond 12 months, then recognize at present value. Okay, so it's very simple, just like our gratuity. No, not gratuity, but I will say PF. In PF, what happens? We just have to pay money to the account of the government, then everything is out. Neither I am worried about investment risk that the assets will be inadequate to pay off my obligation, and the actual risk. What is that actual risk? Risk that my returns will be less than what is expected. That is actual risk. So I make a PF contribution every month. I am out of all my obligations. Over. That is nothing but a defined contribution plan. Vis-a-vis defined benefit plan, either the actual risk or investment risk is on the employer. Friends, nothing but gratuity comes here. Don't you think I have to pay gratuity? How much? Sir, it depends on number of years of services, last salary drawn, and many factors. So I don't know. I will create assets also. Whether the assets will be adequate to pay or not, I don't know. Investment risk is on me, because the employee will say, I want this much. So here standard says, account for defined benefit plan under PUCM, projected unit credit method. Okay, so I have to pay gratuity. So how should that gratuity be accounted in our books? Under projected unit credit method, PUCM. Now friends, I will just do some working with respect to all those things, like what is current service cost and all those things. We'll pass journal entries simultaneously, so everything gets revised out. Now, if you look properly, how should this accounting be done here? Here though obviously very simple is, as far as defined contribution plan is concerned, there is no big problem, because whatever is the amount paid by us is an expense or asset if allowed to be capitalized. And discounting is to be done only if it is to be paid beyond 12 months. Amount payable beyond, if amount paid, then recognize at present value. That is nothing but discounting is allowed. Now friends, of course you will have a doubt, present value. So standard says you should use the government bond rate, not coupon but yield. Coming on to defined benefit plan. Under defined benefit plan, I will just take up some things like current service cost. What do you mean by that current service cost? These are all part of our defined benefit liability. In sense, I am going to pay you gratuity. When I am going to pay you gratuity, when you retire, you are going to retire after 30 years. So after 30 years, I have to pay you some amount, which is nothing but last salary drawn into completed year of services into 26 by 30, if you remember something like that. Yes, very good. So friends, this is recognized, this gratuity which is payable is nothing but a defined benefit plan for us, because neither the actual risk nor the investment risk is on outsiders, both the risk are on us only. What did we say? Either actual risk is on us or investment risk is on us, then it is nothing but a defined benefit plan. So current service cost, I will just pass an entry. What is your journal entry? Your journal entry is nothing but current service cost account debit to defined benefit plan. and this current service cost is transferred to profit and loss. So profit and loss account debit to current service cost, CSC, current service cost. What does it mean? It is increase in defined benefit plan, increase due to services of current year. How it is this measured? Nothing but this is present value of future payments. It is valued at present value of future payments. Then friends, the next point comes is interest cost within this only. What is this interest cost? Nothing but interest cost. The entries, this is not loan interest. Interest cost account debit to defined benefit liability. And then it will be transferred to profit and loss. So profit and loss account debit to interest cost. My dear students, remember this interest is not the loan interest, it is nothing but effects of time, passage of time. It is increase in defined benefit liability due to obligation coming nearer. Interest cost. Thereafterwards, nothing but what do you mean by defined benefit liability? There will be no journal entry for defined benefit liability. That is nothing but a amount. It indicates a liability, amount that is payable to the employees, present value of all amounts payable to the employee. All amounts payable under a defined benefit plan. Okay. So this is our third point. Three things. Fourth, what is past service cost? I will pass in journal entry. Past service cost vested debit to, I will just use the shortcut defined benefit liability. Same way, past service cost, PSC, past service cost, unvested debit to defined benefit liability. And both of them will be transferred immediately to P&L. Whether it is past service cost vested or it is past service cost unvested. Everything will be transferred to your profit and loss account. Clear, my friends? Now what is this? It is nothing but increase or change, increase or decrease in defined benefit liability due to amendment in the plan or change in plan. Earlier I had a plan to give you 2% of final salary drawn. Now I say I will give you 2.5% of final salary drawn. So this 0.5 incremental is nothing but past service cost, because I would have recognized all the cost in the past based on current service cost would be recognized based on 2%. Now I am going to give you 2.5%. So past service vested. Vested means the benefits have already accrued to the employees. If you retire now, you get the benefit. That is vested past service cost. Unvested past service cost means the benefits have not accrued to the employees. You need to complete certain period of service, then only those benefits will be available to the employee. Now coming on to the next area, within this only, E, actuarial gains and losses. On defined benefit liability. Now remember, dear students, everything is based on certain assumptions, presumptions and all those things. But obvious, these amounts which have been presumed have to be verified by an actuary. Actuary will also give us some values. Okay, this is the value at which you should recognize your current service cost. But in subsequent period, you may realize that whatever assumptions, whatever estimates we would have taken do not hold valid anymore. So what we do? We need to change it. So either it can be actual loss or it can be actual gains. We can say remeasurement loss to defined benefit liability, or if it is gain, then defined benefit liability account debit to remeasurement gain. As far as defined benefit liability and remeasurement is concerned, they will be recognized through OCI. So this remeasurement loss or remeasurement gain will be recognized through OCI, other comprehensive income, and accumulated under other equity. Okay, so this is nothing but increase or decrease in a defined benefit liability due to change in actuarial assumption. Now my dear students, the next point, curtailment and settlement. Now curtailment and settlement will basically lead to reduction in the number of employees who will be eligible for plan. Settlement means the plan is stopped in the totality. Curtail means employees under the plan will not be eligible for certain benefits, like there is discontinuing operation, so the benefits will be curtailed and so on. Basically, your entry would be defined benefit liability account debit to bank if settled, and there might be gain on curtailment or there might be loss on curtailment or settlement. Now my dear students, you are creating a liability, but at the same time, what should we do? There is a liability, defined benefit liability, a provision. What should we do? Simultaneously, we should also create an asset, and those assets are referred as plan assets. Now we have something known as plan assets. What are plan assets? Nothing but these are assets held by the entity that will be utilized for paying employee benefits. As I spoke earlier, that there may be 4 entities, state managed entities, group based plan, means these are the entities who are going to manage all those things. I will give money to them, they will manage. So whatever money is held by those plans on behalf of us is referred as plan assets. Means assets held for settling the plan obligations, defined benefit plan obligations. Now if I create these assets, my entry will be plan assets account debit to bank because I created. This is also referred as contribution to the plan. And remember friends, whenever there is a payment to be made, the payment will always be made from plan assets. This is known as withdrawal from the plan. And these plan assets cannot be utilized to pay anything other than employee benefits, except there is a surplus, then it's okay. It cannot be utilized even in case of liquidation. These assets are exclusively for the employees. Clear, my friends? And plan assets are to be carried at fair value, always at fair value. Now comes expected H. Expected return on plan assets. See, if we are creating certain investments which are going to be used for paying off our obligations under an employee benefit plan, then obviously there has to be returns on those assets. Those returns are referred as expected return on plan assets. Basically, it consists of, what is this return? I have to estimate interest and dividend on plan asset, plus realized and unrealized gains or loss on plan assets, other revenue from plan assets, minus some admin cost or I can say some tax payable, so this amount is nothing but expected return. This is our expected return. And what rate we should expect? The rate of expected return should be the same rate that is used for discounting. Now friends, what will be your journal entry for plan assets return? Plan assets account debit to some return, expected return, and then this expected return will be transferred to our profit and loss account. Clear, my dear students? Now let us move on to something known as actuarial gains or losses on plan assets. What are these actuarial gains and losses on plan assets? It comprises of experience adjustments, difference between expected return on plan assets and actual returns on plan assets. There is nothing but actuarial gains and losses on plan assets. Now, if it is gain, then nothing but plan asset account debit to remeasurement. If it is loss, then remeasurement, loss account debit to plan assets. And remember friends, these actuarial gains and losses will be recognized through OCI and accumulated under other equity. Last but not the least, what is your actual return on plan assets? Actual return on plan assets. Friends, what is your actual return on plan assets? Nothing but expected return on plan assets plus or minus actuarial gains or losses. So what I get is nothing but actual return. Here, my dear friends, now I will just give you a presentation. See, actually we have passed the journal entry, so something is added, something is deducted. So how it will go with respect to a defined benefit liability and how things will move for a plan assets. I have a defined benefit liability. So obviously I will be having opening balance of defined benefit liability at the beginning of the year. On that, I will pass an entry interest cost account debit to defined benefit liability. Add current service cost because your entry was current service cost to defined benefit liability. Add past service cost, that may be positive or negative also, less benefits paid, that is nothing but liability settled. If it is actual gains, or I can say curtailment gain, then it will be reduced and curtailment loss will be added. So friends, what we get is nothing but one number. This number, that amount, is compared with amount to be carried forward as per actuarial assumptions. So obviously this amount and this amount, this amount and this amount, this will be different. This difference is nothing but actuarial gains and losses. Difference between these two is nothing but actuarial gains and losses. Clear? Now same way I can have something known as plan assets. The amount to be carried forward as per actual assumption, nothing but the closing balance, that will be shown on my balance sheet. Closing balance of DBL, defined benefit liability. Plan assets, we have something opening balance plus contributions, or I will say we will expect a return and then I will make contributions, plus expected return, some contribution every year we might add, month, depends on our arrangement with the state manager, not state manager, but the entity which is managing our defined benefit plan. Then whenever we require payments to be made for the plan, so withdrawal will come, and this is the balance. And now this balance will be compared with fair value of plan assets. This difference is nothing but actuarial gains or losses, and this fair value is nothing but closing balance, be shown in the balance sheet. Now friends, what you can do is nothing but both these things can be brought together and we can have a net defined benefit liability where the opening balance of liability is net of against opening balance of assets. Interest cost added to liability added to our plan assets can be shown as net interest cost, and so on. So there are two possibilities. The liability is more than plan assets, superb, nothing to worry about, that is known as deficit. And the second possibility is nothing but surplus, wherein the plan assets balance is more than the liability. If there is surplus, then what is to be done? Standard talks about something known as asset ceiling. Now, I will just write it down here. Effect of asset ceiling. See friends, what happens? Generally, you will always find, defined benefit liability will be greater than your plan asset. But if plan assets are greater than defined balance of plan asset is greater than defined benefit liability, then it is referred as surplus. This surplus shall be measured at lower of the surplus amount or the effect of asset ceiling. Remember, my dear students, what does the standard say? It says it should be lower of the surplus or the effect of asset ceiling. Now, what is that asset ceiling? Nothing but present value. What is asset ceiling? Present value of all economic benefits that will come from the plan on account of reduction in future contribution or any kind of refund from the plan. That is nothing but asset ceiling. It is present value of any economic benefit. Available in form of refunds, if any, from the plan, or reduction in future contributions. My future contributions will be reduced. And say, for example, if it is surplus amount, then no issue. But my dear students, if it is asset ceiling, this amount is lower, like this is 100, this is 90, then I will be showing it at 90, so 10 rupees difference will again come. This difference will be recognized through OCI as actual gains and losses. Okay, friends. So we were basically here, we covered this much. Now we come upon long-term employee benefits. Now, dear students, remember, everything is same in long-term employee benefits. What are long-term employee benefits? Sir, long-term employee benefits are those employee benefits which are settled due for settlement after 12 months from the period in which services are rendered. Sabbatical, disability plans, profit sharing plan and bonus plan, wherein it is payable after 12 months. This all comes under long-term employee benefits. Now remember, students, accounting treatment same as defined benefit plan. Same, everything what I did in retirement benefits, defined benefit plan, everything same, current service cost, interest cost, everything same, except that actuarial gains and losses are recognized through profit and loss. So in that case, what was happening? Actual gains and losses are recognized through OCI and accumulated under other equity, under separate heading. Here everything will go through profit and loss account, long-term employee benefits. So the fifth area, that is our last area, termination benefits. Now these are nothing but those employee benefits that are payable as a result of either entity's decision to terminate the services or the employee's decision to get those benefits. Now the accounting should be done in which way? That is very simple. The entity should recognize the related expense and a liability at earlier of following. When the entity can no longer withdraw the offer of those benefits, or when the related restructuring costs are recognized. When the entity recognizes restructuring cost, which includes termination benefits. Okay, my dear students. So these termination benefits will be recognized as an expense and obviously liability. Standard also says this should be discounted if those termination benefits are payable after 12 months. So this is the end of our Ind AS 19. One point which I would like to add up before winding up this chapter and going for next chapter, a carve out. See, under Ind AS, we are required to use which rate? Government bond rate. Government bond rate, and that to yield. But under IAS, we have to use high quality corporate bond. For discounting purpose, under IAS we are using high quality corporate bond rate, whereas under Ind AS it is government bond rate. And remember, in both the cases it has to be yield rate, not coupon rate, my friends. So now let us move on to new Ind AS. To be revised is Ind AS 16. Property, plant and equipment. A very small standard. Let us quickly look at those areas which we should remember. Scope, some definition, mode of acquisition, subsequent measurement, subsequent expenditure and inspection cost, then we will talk about depreciation, and the last area, it is nothing but appendix. A very beautiful area with respect to changes in liabilities pertaining to that PPE. Okay friends, rest there are many areas. Of course, when we do it in the class, you will find that we write down around 11 points there, but I am restricting myself because we are revising everything quickly. Now this standard does not apply. Scope, where it does not, means where do the principles of Ind AS 16 do not apply. So remember, for examination purpose, 105, nothing but non-current assets held for sale. Then we have biological assets because they are covered by Ind AS 41 at fair value. Biological assets, in that two parts are there. One is your living animals and living plants. But standard says in living plants excluding bearer plants, which means the Ind AS applies to bearer plant. Recognition and measurement of exploration and evaluation asset. And the last, mineral rights and similar natural resources. Okay. Then friends, we move quickly to what do you mean by PPE, what is biological asset, not biological asset, but what is bearer plant and all those things. What is PPE? PPE are tangible assets. They are held in business. Now, why they are held in business? So remember, it is held in business for providing goods or services to customer. That is the basic area of us. For production, rentals to other, or administrative purpose. You can say that it is not inventory because these are not held for sale, they are held for use and expected to be used for more than a period, that is a 12 months. This is what our PPE is, A part. Then comes, what do you mean by bearer plants? Because the standard applies to bearer plant. A plant will be classified as bearer plant if it fulfills three conditions. It is held for use in production or supply of agriculture produce, expected to bear a produce for a period of 12 months, and there is a remote likelihood of it being sold as an agriculture produce. Like we have a mango tree. So mango tree is nothing but a bearer plant. It fulfills all the criteria. Now, the standard says you should recognize the property, plant, equipment when it fulfills the definition criteria and recognition criteria. So what is the recognition criteria? Future economic benefit should flow to the entity and cost can be measured reliably. Now friends, how to measure the cost? How should we measure the cost of a PPE? So standard says it depends on mode of acquisition. Now, three modes will be covered in this standard. First, you acquire on cash basis, exchange, and self-constructed. Now, if I acquire a PP on cash basis, then what would be the cost to me? Will be nothing but the purchase price reduced by some trade discount if given, plus direct expenses, all expenses which are necessary to bring the PPE in working condition, plus non-refundable taxes and duties, plus present value of cost of decommission. Okay. This is the amount at which the PPE will be recognized if PPE is acquired on cash basis. Present value of cost of decommission, we will pass an entry PPE account debit to provision for decommission, and that provision for decommission will be unwinded. It means every year interest will be added, but that interest will not be capitalized. As far as borrowing cost is concerned, if this item of PPE is a qualifying asset, then that borrowing cost will be added. In qualifying asset, my friends, it is a subjective concept. We did some questions in our classwork book also. You'll find that in one question it was considered as qualifying asset, in one question it was not considered as a qualifying asset. It was basically an assumption only. When to consider it as qualifying asset, not. Normally a period of 12 months, but there is no thumb rule anywhere. Okay. Now coming on PP acquired in exchange. If PP is acquired in an exchange, then how it should go? Nothing but does the exchange transaction have commercial substance? It means after exchange, whether your cash flows will get affected or not. Your answer may be affirmative or a negative. Does the exchange transaction have commercial substance? Yes. Then recognize PP, or you can say measure the PP acquired fair value of asset given up. If that is not available, then fair value of PP acquired. If that is also not available, then book value of asset given up. If answer is no, then measure book value of asset given up. PP is acquired in exchange. Now the third area, self-constructed. Self-constructed means what? We are only constructing our PP. So what would form part of my cost? Directly attributable, those expenses which are directly related to construction. Allocable expenses, borrowing cost, net cost of test run, present value of cost of demolition or restoration, So what we get is nothing but self-constructed PP. This is nothing but referred as capital work in progress normally. This will be the amount at which it will be measured. Here, my dear students. Now moving on to subsequent measurement, subsequent expenditure and inspection cost. Let us do it together. As far as subsequent measurement is concerned, friends, Ind AS allows two models for valuation. Either the entity goes with historical cost model or it goes for re-evaluation model. What is historical cost? Nothing but original cost less accumulated depreciation less accumulated impairment. So what we get is nothing but the WDV. If we go with revaluation model, nothing but revalued amount, the fair value less accumulated depreciation, that is subsequent, less accumulated impairment loss. Now, it is totally at the discretion of the entity which model to use, but if you go with revaluation model, then that revaluation model is to be applied to the whole class of asset. It cannot be individual. It should be applied to class of asset. And when should we do revaluation? We should do revaluation as and when the carrying amount differs from its fair value. So if there is any difference between the carrying value and the fair value, we should go with revaluation. So we can have revaluation on two occasions. Either it is done for the first time or it is subsequent revaluation. So the accounting is, there is decrease in PPE. We are going to adjust it against profit and loss account. If there is increase in PPE, we are going to credit our revaluation reserve, and that too through OCI. This is for first time revaluation. But if it is subsequent revaluation, then what happens? Then subsequent revaluation depends on what was the previous revaluation. Previous revaluation is downward, subsequent is upward, or subsequent is downward. Previous is downward, subsequent is also downward. We adjust it through profit and loss account. Previous was downward, subsequent is upward. Then to the extent of previous, we will credit our P&L and the excess will go to revaluation surplus. Of course, through OCI. So maybe 5,000 was downward earlier, now there is 7,000 upward. So to the extent of 5,000, we are going to credit P&L. To the extent of 5,000, we are going to credit P&L. And anything above 5,000, we are going to credit our revaluation reserve. Now, previous was downward same way. Previous revaluation was upward. Subsequent is downward. Subsequent is upward. If subsequent is upward, it will be adjusted through revaluation reserve. Subsequent is downward, then first we will adjust it through revaluation reserve to the extent of available balance, and thereafterwards profit and loss. Okay friends, this is with respect to revaluation. Now coming on to the next area, subsequent expenditure, inspection cost, depreciation. Okay, what is to be done for subsequent expenditure? The standard says if it meets, that is fulfills the recognition criteria, then it is to be capitalized. Else expensed off. But remember, if you capitalize a subsequent expenditure, then previously capitalized cost should be decapitalized, if any. Then we have inspection cost, same as subsequent expenditure. What is to be done for inspection cost? Nothing but inspection cost is to be capitalized if it meets the recognition criteria. And previously capitalized inspection cost should be decapitalized. Now friends, what about depreciation? See, remember, depreciation is allocating the cost over the useful life of the asset. Standard wants us to go for component approach. It wants us to follow component approach. That is nothing but dividing the asset into significant components for the purpose of calculating depreciation. Thereafterwards, component approach for significant components. The method of depreciation should be based on the economic benefits. We can also use combination of two methods for the purpose of providing depreciation. If there is change in scrap value, useful life, cost, then or method SLM to W, then it is to be applied prospectively. See, from SLM to WDV is just a change in an estimate. It is not a change in accounting policy. The parameters of Ind AS it does not get triggered off. There is no change in accounting policy. It's just a revision of estimate. But from cost model to revaluation model, that is change in accounting policy. Now friends, moving on to the last area, appendix to Ind AS 16. Now this appendix is with respect to the changes in the value of a liability which is in relation to property, plant, equipment. If you remember, when we were talking about how much cost is to be capitalized, we wrote down present value of cost of decommission, restoration and all those things. So that is nothing but a liability in relation to PP. Now if there are any changes in relation to that liability, how are these changes to be accounted for? This is what our appendix deals with. Okay. So in this appendix, we are going to focus on this area. If there are any changes in the liability, how should this liability be taken care of? See, the cost of PP may change on account of changes in liabilities. It may be result of price adjustments, changes in estimates, and so on, and some taxes and duties are all something like that. Now here I will divide our discussion, friends, into two parts. Part 1, PPE is carried at cost. PPE is carried at cost model, but obvious. So now if it is cost model, I can have two scenarios. What is the first scenario? First scenario is nothing but liability increases. Now if liability increases, what should we do? Very simple, the solution is add to cost of PP. Nothing but your entry would be PPE to provision for decommission, or as the case may be. Second scenario, liability reduces. If the liability is reducing, obviously we will deduct it from the PE, deduct from the cost of PPE. Your journal entry should be provision for decommission, account debit, to PPE. See, in both the cases, remember, if here the PPE cannot become negative, and in above case PP cannot exceed its recoverable amount. Now this was my first area, PP is carried as per cost model. Now my dear students, if we go for the second part, PP is carried at revalued figures. It means we are following revaluation approach. Now here again PP is carried at revaluation. Say liability increases. A. Increase in liability. Now if there is any increase in liability, then again there will be two parts within this, because in revaluation either it can be downward or it can be upward. Previous revaluation downward. Previous revaluation upward. If previous is downward, means can I say we are going to adjust it through PNL only? So nowhere PP is going to come, PNL. If it is upward, then we will adjust it against revaluation reserve to the extent of available balance. And if any excess is there, that will obviously be debited to PNL. The second area, decrease in liability. Now again, when I say decrease in liability, can I say, friends, again two parts? Previous was downward, previous revaluation was upward. Now previous if previous was downward and you are decreasing it, so can I say the amount should be adjusted to profit and loss account, PNL, to the extent of previous. And access to revaluation reserve. Previous revaluation was upward, then obviously adjust through revaluation reserve, because your entry is liability account debit. There is a decrease in the liability, so liability account debit, adjust through revaluation reserve. Then one point standard says that in case of decrease in liability exceeds the carrying amount that would have been recognized had the asset been carried at cost model, then the excess should be recognized through PNL. Here, when there is a decrease in liability, had you followed cost model, and if in under cost model our PP cannot become negative, so we would have credited the PNL. So whatever amount we would have credited to PNL account in case of cost model, the same amount should be credited to PNL even in this case also. Okay. So friends, so this is our appendix to Index 16. Let us move on to another index. Let me start with financial instruments. Basically, my dear students, we are going to deal with Index 32, 107 and 109. What I plan is nothing but I would like to do financial instruments in two parts. Yeah. So part 1 I'll be revising basic concepts, and part 2 I will be going with the advanced concepts. Like in part 1, what is the plan all about in part 1? So I'll say we'll learn something about financial instrument. Learn in the sense revise. Then what is a financial asset? What is a financial liability? And friends, obviously within that, equity. Thereafterwards, some exception to financial liability. Next, preference shares. We'll discuss with respect to how should we deal with preference shares. Contract to buy or sell Non-financial assets. That is the next area of discussion. Derivatives. Of course, we are not going to discuss the accounting of derivatives, but what is derivative? We'll revise it very. Then, what is a compound financial instrument? Thereafterwards, treasury shares, interest, dividend, gain or loss on financial instruments. See, this chapter is a very big chapter, but very simple, friends. Only some concepts we have to repeat it many times. A carve out, very important, pertaining to IAS 32 and scope, where the financial instrument standard should not be applied. Okay, so this is all about our part 1. Now, what are we going to learn in part 2? Here we are going to learn something advanced, how accounting will happen, how measurement will happen, how classification will happen. These all things we are going to learn in part 2. Here classification and measurement of financial assets. For that we have something known as business model test and contractual cash flow characteristics. CCF. Accounting for financial assets, trade date accounting and settlement date accounting, classification and measurement of financial liability, and compound financial instruments. Reclassification of financial asset and financial liability. Reclassification of financial liability into equity and vice versa. Derecognition of financial assets, derecognition of financial liability, then my dear students, we have impairment of financial assets, accounting for derivatives, how we would account for derivatives,
Then we have embedded derivative, hedge accounting. Okay, so these are the areas which I would like to revise with you. Of course, friends, as far as financial instrument standards are concerned, I repeat once again, nothing is tough. Only there are many concepts which we have to revise, repeat and remember. So for part 1, so let me start with part 1 only first and then we'll go with part 2. Okay, so under part 1, what are we discussing? What is a financial instrument? Now you know the definition. Financial instrument is a contract that creates a financial asset for one entity and financial liability or equity for another entity. So there has to be a contract. Now that contract can be oral, written, these, that, whatever are there, but it creates financial asset or it is a financial asset for one entity, whereas it is financial liability or equity for another entity. Hence, there are many items which do not fall under the purview of this standard only, friends, like provision for tax. We don't have contract, so it is not a financial instrument. Similarly, some contingent liabilities, they will never form part of my financial instrument standard. So, financial instrument is a contract that gives rise to financial asset for one entity and financial liability or equity for another entity. So, my friends, a question was there, what is financial asset? Because it gives rise to financial asset for one entity and financial liability or equity for another entity. So, what is a financial asset? So, standard says a financial instrument is a contract. So, what is financial asset? It says a financial asset is any asset that is, number 1, cash. Cash is financial asset. Number 2, equity, instrument of another entity. Number 3, contractual right. 2 parts: to receive cash or another financial asset from other entity or to exchange financial asset or financial liability under conditions that are potentially favorable. And the last, okay, before I move on to the next page part, financial asset consists of 4 things. I've already written 3. It's cash. Cash is a financial asset. The government note, that is a financial asset. Second standard says it is equity instruments. Means we are having equity shares of any other entity, equity instruments, which obviously includes equity shares. So that is also a financial asset. Then it says you have a right to receive, contractual right to receive cash or another financial asset. Like I have convertible debentures, investment in convertible debentures. So what I am going to get? Nothing but another financial asset. Or I have given you loan, so I have a contractual right to receive cash from you. You are my debtors, I have to debts. So that is nothing but right to receive cash or another financial asset from other entity, or to exchange financial asset or financial liability under conditions that are potentially favorable. Nothing but I am holder of call option, or a put option, then obviously those conditions are potentially favorable to me. Fourth, a contract that will or may be settled in the entity's own equity instrument. It means we are going to get our own equity instrument. See, actually in our country it is prohibited. And is a non-derivative. Means the contract is non-derivative, for which the entity is obliged to receive a variable number of own equity instruments or a derivative that will or may be settled other than by exchange of fixed amount of cash or another financial asset for a fixed number of entities own equity instrument. Now my dear students, if you look at an example for a non-derivative, nothing but ABC Limited will issue not issue but it will receive ten lakhs worth of share against sale of a building. What you are going to receive is 10 lakh worth of shares on a particular date. Here I can say ABC Limited has entered into future contract to purchase its own shares. So this is what is all about our financial asset. Now the question comes, what is a financial liability? Standard says a financial liability is any liability. Obviously it's in contract only that is how we had A, B, C, D in our financial asset. Here we have only C and D part corresponding to it. Means cash and equity instrument is not there, but it starts with instead of contractual right, we have contractual obligation to deliver cash. Cash or another financial asset. To another entity. Like I have taken a loan, so I have an obligation to deliver you cash. Bills payable and all those things. or to exchange financial asset or financial liability with another entity under conditions that are potentially unfavorable. Nothing but I am a writer of a call option. Then don't you think the contractual terms are very much unfavorable to me? Thereafterwards, friends, B part. Huh? Financial liability, two things: contractual obligation to deliver cash or exchange financial asset or a financial liability in conditions which are potentially unfavorable. B, a contract that will or may be settled in the entity's own equity instruments. Now see, this is possible in our country, but asset part is not practically possible in our country, and is on non-derivative for which entity is or may be obliged to deliver variable number of its own equity instruments. Entity is or may be obliged to deliver a variable number of the entity's own equity instruments. Example: convertible debentures that will be converted on a future date based on future market price of a share, or a derivative that will or may be settled other than by exchange of fixed amount of cash or another financial asset for fixed number of entities own equity instruments, ESOPs. So we discussed what is financial instrument, what is financial asset, what is financial liability, and now quickly we go through what is equity. So standard says equity. What is equity? Equity is any contract that envisages residual interest in the net assets of the entity. Now one more definition of equity is there, friends. One is there, an equity instrument is any contract which envisages residual interest in the net assets of the entity after deducting all the liability. The other is a very good one, nothing but negative of our what is financial liability. It says an instrument is an equity if and only if both conditions, that is 1 and 2 are fulfilled. Now what are those conditions? Condition number 1, the instrument includes no contractual obligation to deliver cash or another financial asset to another entity. You don't have an obligation to deliver cash or to exchange financial asset or financial liability with another entity in conditions that are potentially unfavorable. This is first condition. Okay, nothing but negative of what we had for our financial liability. Number two, the instrument will or may be settled in the issuer's own equity instrument and is a non-derivative that includes no contractual obligation for issuer to deliver variable number of equity instruments, of course our own equity instruments, or a derivative that will or may be settled only by the issuer exchanging a fixed amount of cash or another financial asset for a fixed number of its own equity instruments. Friends, based on that, you learned something fixed to fix and all those things. So, based on this definition only, you can just say that if it is a derivative instruments, the consideration received or receivable and number of equity instruments. We can have four parameters. If the consideration receivable is variable, number of equity instrument is also variable. The consideration received is variable, the number of equity instrument is fixed. The consideration received or receivable is fixed, the number of equity instrument is variable, the consideration received or receivable is fixed, and number of equity instrument is also fixed. Then what will be the classification of this particular financial instruments? If it is variable, obviously it is financial liability. If it is variable and fixed, then also it is financial liability. Fixed or variable, then it is also financial liability. Only if it is fixed to fix, then we say it is equity. That's why we say fixed to fix, fixed to fix. Yeah, what you receive is fixed, what is going to be given is also fixed, then it is equity. So friends, this is all about my financial asset, financial liability and equity. Now moving on to exceptions to financial liability. It means by going with the definition it will seem it is a financial liability only. But these are not to be considered as financial liability. Now, this financial instrument looks like liability, but it will not be considered as liability. I'll give you some examples of it. Puttable financial instruments. Puttable means right to give it back. Nothing but open-ended scheme of mutual fund or contract to pay cash in ratio of net assets on liquidation. Nothing but close-ended scheme of a mutual fund. So, though this looks like liability, contractual obligation to deliver cash, then also it will be classified as equity. But the standard gives some conditions. Only if these conditions are fulfilled now, friends, then remember these are to be classified as equity. Holder is entitled to pro rata share of entity's net asset. The instrument is subordinate to all classes of instrument it means subordinate means it has given up its priority. All instrument in this class have same identical rights no other obligation to pay other than net assets on redemption or liquidation. Redemption or repurchase. So if all these conditions are there, then only we can say that this is a equity instruments. It looks like financial liability, but it will not be considered as financial liability. Fourth, now with respect to preference shares, how does the classification go for preference shares? Of course, for our contacts in our country, Bharat, it is always and always financial liability because we cannot issue preference shares for a period which is more than 20 years in general cases. But then also the standard does not talk from the context of our country. It is a generalized standard. So standard says preference shares, redeemable preference shares. Now if these are redeemable, at the option of holder or at particular date or at the option of issuer. Friends, it is redeemable at the option of the holder, then of course it is a financial liability for us. But if it is issuer, then it is equity because you don't have any contractual obligation to deliver cash. irredeemable preference shares. If it is irredeemable preference shares, then the classification is now based on other rights. There is nothing but dividend rights. Depends on other rights. Like dividend distribution is discretionary. Whether it is cumulative or non-cumulative. Or you can say dividend distribution is mandatory. If dividend distribution is discretionary, then again it is equity because you don't have any obligation. But if it is mandatory, my dear students, then I will bifurcate it into two parts. Dividend rate is equal to market rate. Dividend rate is less than market interest rate. If your dividend rate is equal to market interest rate, then it is nothing but financial liability. But if it is not, then nothing but it is financial liability and equity. Nothing but, my dear students, this is a compound financial instruments. Next, convertible preference shares. Compulsory convertible or optional? Again, if it is optional, the option is with whom? If it is compulsory convertible, you have to get it converted, it is equity. Of course, to the extent of that conversion part, whatever is the dividend payments which are mandatory, then that part becomes your liability also. If it is optional and the option is with the holder, with the issuer. Now, if the option is with the holder, then this is nothing but financial liability with embedded derivative. And if with its issuer, it is based on intention. You want to repay it off, then it is financial liability. You want to convert it off, then it becomes a convertible instrument. So nothing but a compound financial instruments. So friends, this is nothing but all about our preference shares. Contract to buy or sell a non-financial asset. Now friends, the contract to buy or sell, we were on point number 5. Non-financial assets. This is with respect to transaction in commodity market. See, what does the standard say? Either you have net settlement available, and there is nothing like net settlements, then we'll say else it is not a financial instrument. net settlement means instead of taking the delivery, I can just pay you the price or receive the price. About of net means whatever is the contracted price and whatever is the market price on the date of settlement. The difference can be done. The holder opts for net settlement. Opts for gross settlement. Gross settlement means taking delivery. Now, if you opt for net settlement, then it is a financial instrument. It is to be considered as financial instrument only, friends. You have an intention to, in the past also you have been doing this only. So then we say it is a financial instrument. But if it is a gross settlement, then normally not a financial instruments. Okay. But if company takes delivery and it leads to accounting mismatch, then friends, two parts. Yes, it leads to accounting mismatch. No. If it leads to accounting mismatch, then we will recognize it as a financial instrument and not a financial instrument. Okay, so nothing but I enter into a contract to buy gold. I'm going to go for net settlement. So this contract is nothing but a financial instruments. But if I'm going to go for gross settlement, it means I'm going to take delivery of it. Then in that case, friends, what is to be asked? Whether this you will take the delivery, will it result into accounting mismatch because I have bought a gold because I want to cover up myself against a forward? Then yes, it will lead to mismatch. Then treat this as a financial instrument. Otherwise, no. Then friends comes derivatives. What are derivatives? Derivatives are also contracts only, but these contracts derive their value from an underlying asset. Yeah, a contract that derives its value from an underlying asset is nothing but a derivative. Now, to become a derivative, you need to have three conditions. Means as a derivative financial instruments, means if you want to say it is a derivative financial instruments, then three conditions are to be fulfilled. First condition, value changes in response to an underlying, no or little initial investment. Either it will be settled at future date at gross or net. Either on gross basis or net basis. Then we say it is a derivative financial instrument. The best example is a forward contract or an future contract or an option contract or a swap contract. Then my dear students, coming on to the seventh area, nothing but a compound financial instrument. See, as far as accounting is concerned with respect to compound financial instrument, that I will be doing in the second part only. But what is a compound financial instrument? So, compound financial instrument is an instrument which has characteristics of both liability as well as equity. If you look properly, I made you write down preference shares. Dividend distribution is mandatory. It was an irredeemable preference shares. It means I don't have a contractual obligation to deliver what? The principal. But then I will be paying dividends. It is mandatory. Now, if dividend is mandatory, then perpetual cash flows to be discounted. Now, if this perpetual cash flows are discounted using market interest rates, then there is no problem. The whole instrument becomes financial liability, which we wrote here, financial liability. But what if, my dear students, the perpetual cash flows are to be discounted using market rates, but the cash flows are not based on market rates, the cash flows are based on less than market interest rate. Then such financial instruments are referred as compound financial instruments. Our India says you need to segregate a financial instrument which has component of financial liability as well as equity. So this financial instrument will be segregated. How much is financial liability and how much is equity? Okay. So how to segregate it, when to segregate, this all initial recognition only segregation happens. This all we are going to learn in the part 2. Now comes treasury shares. Concept is there, but not applicable from our context. That is, in our country it's not allowed, it's prohibited. Shares held within the group not to be recognized as financial asset, shown as reduction from equity. Gain or loss will be recognized on purchase sale through P&L. Whatever amount you paid, that is consideration paid for own equity instruments, will be reduced from equity. See, if you are holding shares on behalf of others in your own entity, then those are not considered as treasury shares. They are not treasury shares. What is to be done with respect to interest, dividend, gains and losses? Remember, any interest, dividend, incomes and gains and losses will be recognized through P&L. Though the underlying instrument would be classified through OCI, but interest, dividend, everything will go through profit and loss. Transaction cost into equity is also classified, means shown as reduction. Now comes our carve out. Now dear students, foreign currency convertible bond, that is the carve out. Of course, from IAS 32, this carve out is there. Now, this foreign currency convertible bond under IAS is regarded as liability. But under our Ind AS, it is considered to be equity. It says that the fix to fix test is considered to be satisfied as long as number of shares on conversion are fixed and the conversion price in foreign currency remains fixed. Now this variability comes because of what? Mainly due to foreign currency fluctuations. So that has to be ignored. Is merely due to foreign currency translation, then such variability is to be ignored. Okay, and the last area, scope. See, the financial instrument standard does not apply. Where it does not apply? Where other standards are applying. So obviously our other standards are applying to interest in subsidiary, associate and joint venture, that is covered by 110, 28 and 111. Rights and obligation under lease, because that is covered by 116. Employees rights and obligation under a defined benefit plan, that is covered by our Ind AS 19. Rights and obligation these rights and obligation under insurance contracts, they are covered by Ind AS 104. Contract between acquirer and acquiree to buy sell the acquiree entity, that obviously is under 103. Then share based payment, yes. See, these are all financial instruments, but because we have some other standard, the parameters, the principles of those standards will apply, and it will not apply here. Reimbursement right, that is our covered by Ind AS 37, and rights and obligation under contracts with customer. Okay, my dear students. So this is all about our part 1. Part 1, the most focused area is what are financial assets, financial liability, equity, obviously exception to financial liability, and remember one statement, fixed to fix. What is received is fixed, what is receivable is fixed, and the equity instruments to be issued is also fixed. Then that instrument is classified as equity. Okay. So now my friends, my part 1 is over here. I'll continue with part 2. Okay. So let us move on to part number 2. The first area is nothing but classification and measurement of financial assets. How financial assets will be classified and how they will be measured.
Classification, measurement of financial assets. I will also do the contractual cash flow characteristics test and business model test along with this discussion only. So both these points we will be doing it together. Now see, friends, for classification we have 3 ways. At amortized cost, at fair value through other comprehensive income. Now of course this is a residuary category. Fair value through profit and loss. Now this is how our financial assets will be classified and accounting treatment will depend on this classification. Now how to identify which financial asset will be under which model, whether it will be at amortized cost or it will be at fair value through OCI or it will be at fair value through P&L. For that purpose we have to take into account the contractual cash flow characteristics test and business model test. The classification of financial assets is based on following test. CCFC, that is contractual cash flow characteristic test. Henceforth I will use the word CCFC test. The second test is nothing but business model test. Now any financial asset will be considered to have fulfilled the contractual cash flow characteristics test provided its cash flows are solely the payments of interest and principal. SPPI, that is the term which we used to use. Sole payments of principal and interest. Okay. I just write down a financial asset fulfills CCFC test, if its cash flow are solely payments, principal and interest on the principal amount outstanding. And these payments, this interest should be in line with the basic lending arrangement. Means it cannot be any unreasonable value. Now, what is a basic lending arrangement? So, the payments have to be in line with basic lending arrangement. Nothing but it takes into account time value of money. You can say I give you a loan, I am charging you 2% interest. So you can't say that 2% is in line with basic lending arrangement. No, it is not, because it does not take into account time value of money, nothing but inflation. It should also consider credit risk associated with the principal and reasonable profit margin. Now, if this is there, then I can say my contractual cash flow characteristic test is fulfilled. Like if I issue a bond wherein the interest rate is market interest rate based on index RBI base, then yes, it is. But if I issue a bond which pays inverse of floating market interest rate, then SPPI test is not fulfilled. They are not the sole payments of principal and interest on principal. I take up a bond which gives me return based on gold rates. So then what is happening? I am getting a compensation, but the compensation is not in line with a basic lending arrangement. Then we can say contractual cash flow characteristic test is not fulfilled. So first of all, whether a financial asset fulfills the contractual cash flow characteristic test, that has to be considered. And thereafterwards, the next test comes is business model test. This is for CCFC. CCFC, I wrote this much. And then friends, I have something known as business model test. Now what can be my business model? I am holding, that can be my business model. I am holding the financial asset to collect the contractual cash flow till its maturity. Or my business model would be to hold the financial asset to collect contractual cash flow and also sell the financial asset. I may sell off the financial asset also. Means if I get an opportunity, I may sell it off. But in one case, my objective is to hold till its maturity. In other case, I have purchased this investment to receive this contractual cash flow, or I may sell it off also. And you can have other business model also, like I am holding this for trading. Held for trade, or the nature of financial asset is that it does not give, or you can see it does not have contractual cash flow, like equity shares. Now friends, how it will be decided, whether it will be fair value through P&L, whether it will be fair value through other comprehensive income, or it will be fair value through profit and loss. I'll just make a small chart. First of all, a financial asset is a derivative or held for trading, or the financial asset is equity instrument, or I can say other financial asset. If it is a derivative or it is held for a trading, then fair value through profit and loss, FTPL. If it is equity instrument, by default there is only one option, but there can be by choice, or I can say by exercising another option, I can classify this equity shares at fair value through OCI, but of course that will be not to be reclassified to P&L. If it is other financial asset, then your first question should be, is CCFC test fulfilled? Is CCFC test fulfilled? Means does that instrument have a contractual cash flow, which is SPPI, sole payments of principal and interest on the principal? So obviously you will have two answers. Yes, it is fulfilled. Answer is no, it is not fulfilled. If it is not fulfilled, friends, then the standard says only one option is there, fair value through profit and loss. This is a residual category, I can say. But if it is fulfilled, then you should ask, why are you holding business model test? Why are you holding this financial asset? So you can say two parts. I am holding the financial asset to collect cash flows, or you say I am holding the financial asset to collect cash flow and to sell it also. I may sell it also. If I get an opportunity, then I may sell also. So if it is collect cash flow, then we will go with amortized cost. If it is to collect cash flows and sale also, then it will be fair value through OCI. Of course, here it is R. R it means it will be reclassified back to P&L. So whatever I have written is red pen. You will see that this is the classification to be done for the purpose of accounting. So whether the financial asset will be at amortized cost or a fair value at OCI or at fair value through P&L, it all depends on this. Okay. Now my friends, the standard says an asset has to be designated at fair value through P&L on initial recognition if it helps in correcting an accounting mismatch or some inconsistency. Means the asset is in such a nature that it is against a particular financial liability. I have created an asset, and the liability fair value changes are measured through P&L, then this asset fair value changes will also go through P&L. By default it will be through P&L. So it will be irrevocably designated as fair value through P&L if it helps in correcting accounting mismatch. Now measurement. Standard says all financial assets should be measured at its fair value. at its initial recognition. Difference between the transaction price and fair value has to be accounted according to the principles. Like, how did you determine the fair value? Level 1 input, level 2 input, what is the way you determine it? If it is level 1 input, then the difference between the transaction price and fair value will go to P&L only. But if it is level 2 input, I am talking about Ind AS 113. There is where we have level 1, level 2, level 3 input. So, if the fair value is determined based on level 1 input, then everything will go to P&L. But if it is level 2 input, then the difference will either be amortized, like you gave a loan to the staff at concessional interest rate. So, the fair value of the loan is less than the loan amount. Difference was referred as staff benefit cost. Then, what about transaction cost? Nothing but commission to agent, advisor, broker, dealer. If it is fair value through P&L, it goes to P&L. Transaction goes to P&L. If it is fair value through OCI, it is added. Financial asset. If the financial asset is at amortized cost, again it is added to financial asset. This is with respect to our classification, measurement of financial assets, CCFC and BM test. Now friends, as I was talking about the difference, let me write it down. Difference between fair value and transaction price. Fair value is based on level 1 input. Fair value is not based on level 1 input. So, if fair value is based on level 1 input, charge the difference to P&L. Recognize the difference as asset or else amortize it. Like how I said, I gave a loan to my staff members. So, our entry is what? Loan to staff, account debit. I gave concessional interest loan. So, loan to staff to bank. Say, I gave 100, but this 100 I could have given at 10%. I gave it say 7%, something like that. Then this loan to staff will be at which value? So, obviously, this is transaction value. It will be at fair value, which is 70. So, this difference is nothing but staff benefit cost that will be amortized. Assuming that, yeah, this I am just writing down the number. This is what it is going to happen. And then, if this is amortized cost model, friends, then we need to prepare an amortization table. It will be carried at amortized cost. The asset, the financial asset will be carried at amortized cost, and for that purpose we prepare that amortization table: opening balance plus interest minus payments, closing balance. and that amortization table is to be prepared considering the EIR, effective interest rate. It's nothing but the actual return. Then subsequent measurement of financial asset should be at amortized cost. Based on effective interest rate. Now, if it is at fair value, what does it mean? If financial asset accounted at fair value, it means at every point of time, the value of that financial asset should be at fair value. I am talking with respect to this, my dear. At amortized cost, it is done, no issues. But what if it is at fair value? Then what? Then it should always be at fair value only. And any changes will be recognized through profit and loss account. If it is OCI, then of course we will prepare an amortized table, and the difference between the amount as per amortized table and the fair value will also go to your other comprehensive income. This is with respect to accounting for a financial asset. Now, friends, the another area, trade date accounting. And settlement date accounting. Nothing but when do we recognize that financial asset in our books? Either when the trade occurs or when the settlement occurs. Nothing big. Trade date accounting refers to entity commits delivers the asset or acquires the asset. Trade date accounting refers to the date on which entity commits itself to buy or sell the asset. I will recognize the financial asset on that date only. But settlement date accounting means I will recognize that asset only on the date of sale. Like in stock market, how we have T plus 2. I enter into trade today. So settlement happens after 2 days. So when would I capture that particular financial asset in my financial statement? The date on which I enter into the trade, or the date on which I actually get the delivery, or the securities are removed from my demat account. So trade date accounting, settlement date accounting is with respect to when that item is getting captured. So if it is trade date accounting, whatever is the fair value changes will obviously affect the financial asset. But if it is settlement date accounting, then the fair value changes, there will be no asset in my books. Today I enter into trade with you to buy, but there will be no accounting done with respect to today. Any changes happens with respect to fair value, and if I have measured the financial asset, or I am going to measure the financial asset at fair value, then in settlement date accounting we are going to capture the changes, and that only changes, not the whole asset. Moving further within financial asset, my dear students, I'll say some special situation. Modification of a financial asset due to changes in cash flows. Modification because of change in cash flow. Now you will say, how can cash flow change? See friends, I would have given you a loan and you are supposed to pay me the equated monthly installment of 10,000, 10,000 and so on. Based on that, I would have calculated an EIR. Now in between, you come and make a lump sum payment of 50,000, partial repayment you may have done. Don't you think my cash flows will change now? And as a result of that, I have to find out what would be the revised carrying amount of my financial asset. So carrying amount of financial asset on date of modification, compare it with revised carrying amount of financial asset after modification. Yeah, using the old EIR. This is the difference. Either goes to profit and loss or it is adjusted against the amortized value. The second scenario can be renegotiation. Of financial asset. What is renegotiation, friends? Changes in terms like the interest rate, the period, the contractual terms are being changed. In modification, what was happening? Change is happening in the cash flow, but that change in cash flow is happening on account of the terms which are already there in the contract. So here renegotiation of a financial asset. So carrying amount of financial asset on date of renegotiation revised carrying amount of financial asset after date of renegotiation. This is the difference. What we will do with this difference? P&L, or of course this renegotiation if you do, then you should use using revised EIR. It is not old EIR but revised EIR. Profit and loss or adjust against amortized value. The third can be floating interest rate financial asset. My financial asset, I have made an investment and that investment is in a financial asset which is floating interest rate. So if it is floating interest rate financial asset, what we should do? Recognize financial asset at fair value on initial recognition. No amortization table. Interest received as and when whatever amount is received will be credited to profit and loss. Here, my dear students. So this is all about some special areas of our financial instruments. Coming back to, we have completed this, trade date accounting, classification and measurement of financial liabilities and compound financial instruments. Now how we are going to take care with respect to compound financial instrument and financial liability. Let us recapitulate it very fast. Classification and measurement of liability. Then I will do it with respect to our compound financial instrument. I will just talk with respect to liability and equity, will do it simultaneously only. What does the standard says? Standard says all finance, there is nothing like cash flow characteristics test, nothing like business model test, nothing. There are only two classification will happen. All financial liability should be at fair value, the list is given, others will be at amortized cost. Over. All financial liabilities are measured at fair value. Subsequent measurement of financial liability depends on classification. Now what is this classification, friends? Two classification. Financial liability at fair value through P&L and financial liability at amortized cost. Now, this is nothing but using EIR. Which liability will go under which way? Remember, following financial liabilities will be at fair value through profit and loss. Derivatives, unless we are using hedge accounting, held for trading. These are the list of financial liabilities which will be at fair value through P&L. Designated at fair value through P&L. Now we are only designating it at fair value through P&L in order to avoid mismatch. Contingent consideration. If contingent consideration is a financial liability, then it will always be at fair value through P&L. And the last, financial guarantees. Other than this, all other liabilities will be at amortized cost using EIR. Means, of course, initial recognition will happen at fair value, and then we will prepare that amortization table like loan taken, debenture issued, creditor, deposit taken. These are all other liabilities. They will always be at fair value on initial recognition, and subsequent recognition will be at amortized cost using EIR. Okay, friends? As far as transaction cost is concerned, in this case, transaction cost charged to P&L, whereas here transaction cost will be deducted. Transaction cost will be deducted from my initial recognition of liability. So this is what we would have done even in the classroom. Not that much challenging. Yes, I would suggest financial guarantees. We will be coming on it and we will be discussing. Now comes one more point. Of course, I have to go for compound financial instrument, but before I jump to compound financial instrument, friends, how equity is to be considered? What is to be done for equity? There is no classification principle for owns equity and no remeasurement is to be done. Equity, once recognized at particular value, it will be carried at that value only. Okay? No changes in fair values and all those things should be considered. As far as equity is considered, remember my dear friends, there is no classification principle. For own equity. It is always carried at its initial recognition value. Fair value changes are ignored. So any kind of fair value changes are there, they have to be ignored of. Compound financial instruments. Now friends, how should we go for compound financial instrument? Nothing but an instrument which has characteristics of both financial liability as well as equity. So we need to bifurcate it between how much financial liability and how much equity, and from the perspective of the issuer. So the important points is that only, that we need to bifurcate. It has characteristics of both financial liability as well as equity. Of course, the example is convertible debentures, bonds, or preference shares, either compulsory or optional. Yeah, from issuer's perspective, we need to bifurcate the liability and equity component. And remember, we should always calculate the liability component and the balancing figure will be equity component. Under no scenario you should calculate equity component and balances liability. Okay, we calculate liability component how do we calculate? By discounting the contractually agreed cash flows which are in the nature of financial liability using market interest rate. Okay, So now my friends, what happens is we have some proceeds received. You received some amount by issuing convertible debentures. From this we will deduct liability component. So what is left out is nothing but equity component. And how do you find out this liability component? It is nothing but present value of contractual cash flows. Whatever cash flows are there, that you have to consider. Now see, remember, important point. If it is compulsory convertible preference shares or debentures or a bond, then only interest payments will be discounted. But if it is optionally convertible, then optionally means the holder has a right either to demand for conversion or to demand for payment. If that is the scenario, my dear students, then what are we supposed to do? In that case, we will be discounting interest as well as principal. But if it is compulsory convertible, then we will be discounting only and only interest component. And that we will be getting present value, and we will be discounting using what rate? We will be discounting it using market interest rate or similar interest rates. Okay. If nothing is specified, then interest is considered to be mandatory. And conversion is compulsory. So friends, when we issue, what will be the journal entries at the time of issue? Bank account debit with the proceeds received to the debenture or bond, LC, that is liability component, to debenture, equity component. Now whatever is equity component, that will not be remeasured, because we learned now only earlier point. What did we learn? Equity, whatever amount is recognized once, will be continued forever. There is no change in equity. But this liability component will be now carried at amortized cost, subsequent measurement, yeah, using EIR. Now this is journal entry at the time of issue of a compound financial instrument. What would be the journal entry at the time of redemption or conversion, you can say? Friends, that goes in two parts. Either it is compulsory convertible or it is optionally convertible. Compulsory convertible, then so you will be only having debenture equity component account debit to equity share capital and security premium. Because then the liability component would have exhausted, because you pay the interest, everything exhausted. But if it is optionally convertible, then two scenarios can be there. First scenario, the holder demands payment. It means they say, we don't want to get it converted, give us our money. So it's very simple. Debenture liability component account debit to bank. Debenture, whatever is the equity component, will be transferred to other equity if you demand payment. If they opt for conversion, what is to be done if they opt for conversion? Then very simple. Debenture liability component account debit with the amount which is there closing balance as per amortization table. Debenture, equity component account debit. 2. Equity share capital and securities premium. Clear, friends? Okay. Now comes, what about transaction cost which is being incurred in case of a compound financial instrument? How should transaction cost be considered, my friends? Very simple. As far as transaction cost is concerned, we will bifurcate the transaction cost between this amount and this amount. Nothing but gross carrying amount. Transaction cost will be bifurcated between liability component and equity component in the ratio of gross carrying value. It means gross carrying value means nothing but the value before deduction of transaction cost. Whatever is the value, that value will be referred as gross carrying value. We will bifurcate it. Now, what is the accounting treatment for financial liability if transaction cost happens? It is to be adjusted through the financial liability. It means it will be reduced from the value of financial liability. So, my financial liability will be reduced. Similarly, as far as equity is concerned, it is reduced from security premium. Equity also it is reduced. Only if it is subsequent transaction cost, then it goes to P&L. This is not subsequent. This is nothing but at the inception. At initial measurement, transaction cost is being incurred. So, my dear friends, what we will do? We will reduce it from equity component only. The moment you reduce transaction cost from debenture liability component, you again have to find a revised EIR. Now, your EIR has to be revised. It cannot be the same EIR which was there at this point of time, the moment you reduce it. Yeah, so this is all about our transaction cost and compound financial instrument. Now, friends, moving on to reclassification area, the next point. Reclassification of financial asset. When should you do reclassification? Only when the entity changes its business model. Of managing financial assets. Now, my dear students, we can have basically 6 scenarios, because under classification we had learned that financial asset can be at amortized cost, it can be at fair value through OCI or fair value through P&L. So, obviously within 3 only we have to jump from here to here. So, I will create those 3 scenarios. Financial asset is at amortized cost and it is reclassified at fair value through P&L. It is at amortized cost, the first part, and it is reclassified at fair value through OCI. Now, what should we do? If it is there at fair value, nothing but remeasure the financial asset at fair value and difference between the amortized value and fair value is recognized through P&L. Reclassified at fair value through OCI. Nothing but remeasure the financial asset at fair value and the difference between the amortized value and fair value is recognized in, or I can say recognized through OCI. And remember, whatever will be the interest revenue and whatever will be the EIR, that is going to remain same. So whatever is there in amortized cost model, we prepare that table, amortized table, that same table will be there. Every time what happens, whatever is the change in the closing balance, we try to realign it with the fair value. And that is accumulated under equity. The second scenario. What is the second scenario? Financial asset is at fair value through P&L. Financial asset is at fair value through P&L. Can I say, in this I can have two areas. What can be the two areas? Reclassified at amortized cost, reclassified at fair value through OCI. Now if it is at amortized cost, then the fair value on the date of reclassification becomes the amortized value. Nothing will go to P&L and something like that. Whatever is the fair value becomes the amortized value, and EIR is calculated based on that value. Okay. Now friends, here the financial asset is already at fair value and will continue to be at fair value. But if you are going through OCI, what is going to happen? Now whatever fair value changes will be there, that will be accumulated into OCI. Of course, calculate EIR based on fair value on reclassification. Now the third area, that is financial asset, is at fair value through OCI. And it is being reclassified amortized cost now. What happens if it is reclassified to amortized cost? It is already at OCI. So, fair value changes accumulated through OCI are adjusted against fair value. That results in the financial asset being measured at amortized value. Hence, what will happen? See, even in OCI, my dear students, what we do is nothing but we prepare the amortization table, and whatever is the closing balance as per amortization table and whatever is the difference there, that fair value changes we have been doing. So, those fair value changes have been accumulated. Now, what we will do? We will say, okay, those fair value changes, let us adjust it to the asset. So, that results in financial asset being measured at amortized value as if it had always been there at amortized value. EIR is not adjusted. Whatever is EIR, that will be continued as it is. Now, financial asset at fair value through OCI reclassified at fair value through P&L. See, this option is only for debt instrument. For equity instruments, if you have taken OCI option, then it is permanent. You cannot come back. Now, don't you think here it is already at fair value? Financial asset is already at fair value and no adjustment required with respect to the amount at which the financial asset will be there. Yeah, the amount of fair value changes or the fair value changes accumulated have to be reclassified from equity to profit and loss. So this is all about our fair value changes happening. So financial asset at amortized cost, two options. Financial asset is at fair value through P&L, again two options. And financial asset is at fair value through OCI, again two options. Here, my dear students. Now comes what about financial liability? Remember, for financial liability, we had two options. What were the two ways of classification? At fair value and at amortized cost. If you remember, what was there at fair value? 5 items I had written. Standard clearly says reclassification of financial liability is not permitted. Reclassify from year to year to year, never can you do. Reclassification of financial liability is not permitted. Here, my friends? Okay. Now, moving on to, can a financial liability become equity and equity become, yes, why not? I think we had that point also. Starting. Reclassification of financial liability and financial asset. Reclassification of financial liability into equity and vice versa. Okay, so this vice versa, let us do it. Reclassification of financial liability into equity and equity into financial liability. Like just previous discussion we were doing about compound financial interest. It is optionally convertible, my dear students. If it is optionally convertible, it means you may ask for money, you may ask for shares. So what we do, we find out the financial liability based on interest as well as principal component. But at the end you say, no, I don't want the money, I want shares only. So don't you think that financial liability will get converted into equity? This is what optionally convertible, point number 1. See, optionally convertible, point number 1, demands payment, then debenture liability to bank. But if you don't demand payment, you are asking for conversion. So debenture liability component to equity share capital. Yeah. Financial liability is reclassified as equity. Means it is to be reclassified at the carrying value. Whatever is the carrying value, on that amount only it will be reclassified. No change is required. And obviously no difference will arise. But an equity becomes a financial liability, like putable financial instrument, my dear students. Don't you think? Units of mutual funds of India. Units in a mutual fund. What happens? Those units in a mutual fund are classified as equity. It is exception to financial liability. Now, the standard says this is not equity, it is liability. Why? Because they have demanded payment. They have to make payment. It is reclassified to financial liability at fair value on the date of reclassification, and difference is adjusted through reserve, that is nothing but equity, not P&L. The difference, if any, is adjusted through equity. Done? Okay. Now, my dear students, we go for the next discussion, and that is very, very important. Derecognition of financial assets. Now, derecognition means remove that financial asset from our books of account. That financial asset is removed, either it is sold, disposed of, or some kind of arrangement is done. Remember, if and only if the risk and reward that are related to the financial asset that has been transferred, then we will derecognize the financial asset. I will discuss this area in certain number of points. The first point is, say, bill receivable. If I discount a bill receivable, then what happens? I get money from the bank and bank charges some discount. Bank holds the bill till its maturity date, and on the date of maturity, the bank will proceed to collect the amount. If the drawee fails to pay, then the bank is going to catch hold of me and they will say, give us our money. Hence, if you look properly, the risk is not transferred to the bank on discounting. Yeah, on discounting the bill, hence no derecognition is to be done. We should not derecognize. Why? Because the risk and reward is not transferred. So what should we do, my dear students? Account the transaction as financing, or I can say loan transaction. Like, say, in our balance sheet, we have a bill receivable of rupees 5,000, we discounted it for 4,800. So I received 4,800. So what will I do? Nothing but bank account debit to loan 4,800, and then interest account debit to loan 200, and on maturity what will happen? There are two possibilities, either it is honored or it is dishonored. If it is honored or it is dishonored. If it is honored, then very simple, loan account debit to bill receivable. But if it is not honored, then we need to pay off full 5,000, and the bill will still be there in our books. So this is first part with respect to bill receivable. Here friends, so simple. Now let us move on to the second part, and that is factoring. Nothing but I give you the right to collect the money from my debtors. If I give you the right to collect money from my debtors, that is nothing but factoring. I am selling off my debtors. So the standard says this factoring is either with recourse without recourse. If it is with recourse, it means factor does not bear the risk of bad debt. And here factor bears the risk of bad debt. Now if it is with recourse, do not de-recognize the debtor, because the risk is not transferred to the factor. Do not de-recognize the debtor. Accounting similar to bill receivable. Means you have taken a loan. So whatever we did accounting for bill receivable, the same thing will be there. Nothing but first bank account debit to loan, interest to loan. On maturity, you receive money, so loan to debtors. If you don't receive money, loan to back. But if factor is going to bear the risk, then what should we do? De-recognize the debtor. Remove the debtor from your financial statements. So de-recognize the debtor, and the difference between carrying amount, that is nothing but the financial asset amount, carrying amount, and consideration received, recognized through P&L. So this is all about our factoring part. Now moving on to sale and repurchase of a financial asset. I have entered into sale and repurchase, also referred as repo. So I am going to sell off my financial asset to you, and at the same time I have entered into a contract to repurchase back the same financial asset. So here we can have two scenarios. The price at which I am going to repurchase repurchase price is fixed price adding some interest rate. Or you can say repurchase price is at fair value on the date of repurchase. So, the day you are going to repurchase, what is the fair value on that amount you are going to repurchase. So, standard says if repurchase is at fixed price only, that I am sold you for 100 and I will buy it at 100 plus the interest. It means the transaction should be accounted as loan transaction, it is not sale of securities. Do not derecognize the financial asset. Account it as loan transaction. You have taken a loan, so whatever securities are there, they will be shown in the books because the risk and reward pertaining to it is with me only. It is as good as I have taken a loan and mortgaging these securities. But if repurchase price, then can I say derecognize the financial asset sold? Because this is nothing but a transaction of sale of securities and again purchase of securities. So account it as similar to without recourse. Factoring without recourse. Yeah. Difference between carrying amount and consideration received will be recognized through P&L. Now, so bank account debit difference to the financial asset. Now, friends, subsequently if I buy it back, I have to buy it back. It is not an option contract, but it is a forward contract. I have sold and I will buy it back. Then what should we do? Again, investment account, purchase of investment entry will be at the time of repurchase, investment account debit to bank, whatever you have bought, that financial asset. So that is our sale and repurchase, repo. But sale and repurchase is option, either a call or a put. Now, repo price is fixed price which is deeply in the money. Repo price is fixed price which is not deeply in the money. I hope you remember the language in the money, at the money, out of money. If it is deeply in the money, it means the option will be exercised. It is not deeply in the money, it means low chances of exercise or no exercise may happen. What should be done? Same. Do not derecognize the financial asset. Account it as a loan and repayment. Here what we should do? You are not going to exercise. De-recognize the financial asset. Difference between carrying amount and the selling price will go to P&L. Now say for example, today it is not going to be exercised. This is what it looks because it is deeply out of money. But maybe subsequently it comes to our knowledge that no sir, it is in the money only, it will be exercised and it actually gets exercised. Then nothing, recognize the investment account debit to bank. This is all about sale and repurchase. This is forward or a future type of contract. Of course, I should use the word forward only, not future. And here this is an option contract. The next way of derecognition of financial asset is through securitization. Now in securitization, what happens? We are holding some loans. And some assets are there. Basically loans. And what we do is nothing but on the basis of this loan, we issue certain securities, participatory notes. So the entity is holding a portfolio of loans and may issue security to the investor on the basis of this loan, which is referred as certified participatory notes. This process is referred as securitization. Now the question arises, these assets, loans, should this be derecognized? Now if you look properly what is happening, the entity holds the right to collect cash flows, whatever cash flows that will arise from these assets. That right we have, we will collect the cash flow. The risk and reward may get transferred to the holders of these certified participatory notes. If the risk and reward gets transferred, then derecognize. Now, when should we say the risk and reward is transferred? With respect to the loan assets, we are holding those loans. When can I say the risk and reward is transferred? Friends, the entity is holding the loans under a contractual obligation to deliver specific proportion of amount collected. That is, if lower amount is collected, I will give you lower amount only or proportionate lower amount. Entity holding the loan is prohibited from selling or pledging the loan. The entity holding the loan is an obligation to remit cash flow to investor. Which investor? Those who are holding our participatory notes. Then we should derecognize. That is all about securitization. The sixth point is nothing but continuing involvement approach. Now, what happens in this case? We transfer the financial asset on non-recourse basis. It means the risk has been transferred, non-recourse basis. But, along with a guarantee given for part of an asset. For some part of the asset, we give guarantee. Then it is referred as continuing involvement approach. Now, what is the accounting treatment? Derecognize. What are we supposed to derecognize? The financial asset. What should we recognize? Record continuing involvement asset at lower of carrying amount of financial asset transferred or guarantee amount. Third, recognize the associate guarantee liability. Now, what is the guarantee liability? Guarantee amount plus fair value of guarantee commission. Now, this fair value of guarantee commission should be amortized to P&L. This should be amortized to P&L over the guarantee. Any difference arising from it, see, credited will be the financial asset, debit will be the continuing involvement asset, guarantee liability will be there. Any difference, to be recognized through P&L. This is amortized to P&L over the tenure, not immediately. Okay, my friends. So this is what all about your continuing involvement approach. Now coming on to within this partial derecognition. Means the whole financial asset is not derecognized, the partial amount is only derecognized. So whatever is the carrying amount, that has to be bifurcated between the asset which is not derecognized and the asset which is derecognized. the difference for which we have received the consideration goes to P&L account. Okay, so nothing but very simple point. Calculate the fair value of the part transferred and fair value of the part retained. Split the carrying value in the ratio of fair value of part transferred and retained. So obviously you will be getting gain or loss. Derecognition transfer to P&L. Now what would be the gain or loss on derecognition, friends? Nothing but sales value, the amount which you received from that carrying amount of part derecognized. PCA is nothing but proportionate carrying amount of the part derecognized. That is nothing but part which is sold, transferred. So this is all about our derecognition of financial asset. Now let us move on to derecognition of financial liability. Now derecognition of financial liability, friends. What does our Ind AS say? Ind AS say a financial liability is to be derecognized. I am talking about full derecognition. Then we will talk about modification and then partial derecognition. Three things we have to talk or revise with respect to financial liability. A financial liability is to be derecognized, means removed from the books. When should I remove from the books? Only and only when the obligation specified in the contract is discharged or cancelled or expired. Okay. Now this is all about full derecognition. When should we derecognize? So when only that obligation has been discharged, complete, means I am absolved of all my liabilities. Any difference which arises due to it on account of removal of that liability should be recognized through P&L. Now the second comes is modification. Now in this, the Ind AS says there can be two ways. Either we can go for extinguishment accounting or we can go for modification accounting. The terms and condition of an existing loan is revised. That is nothing but a modification. So whatever are the terms and conditions, now we are going to have some new terms and conditions. Modification accounting, nothing big in that. So either I go with extinguishment accounting or I go with modification. When should I go with which accounting, that I will talk later. But if it is extinguishment accounting, then friends, what happens? Nothing but we remove the old loan and bring the new loan. So old financial liability account debit to new financial liability, and the difference is recognized through profit and loss. But if it is modified accounting, here Ind AS is not clear what to do, but I can just give you an idea. Either you apply approach 1 or approach 2. Now if I go with approach 1, what is going to happen? Very simple. Adjust the carrying amount, means we don't remove the liability, adjust the carrying amount. With the EIR being constant. My EIR will remain constant, but there is modification, so the cash flows would have changed. So with the same EIR at which we would have recognized the financial liability initially, the same EIR continues to be there, and we will find out what should be the revised carrying amount. So obviously there will be the difference. This difference will go to P&L. But if we adopt approach 2, what we do is nothing but we adjust the EIR. Means we find out revised EIR based on revised cash flows. So no difference. No difference will arise. Now, when to go for extinguishment accounting or when to go for modification accounting? Yeah, whether to use approach 1 or approach 2, Ind AS is 109 is not clear on this. There is a silence. I would suggest we should go for approach 1, that is simplicity, rather than going for approach 2. In exams, we should write a note. Now, if the difference between the present value of modified cash flows and the carrying value of the financial liability is more than 10%, then I will go with extinguishment accounting, else I will go with modified accounting. Like difference, first we have to calculate the difference. What difference? Present value of modified cash flow. Because of modification there will be modified cash flow, of course, at old EIR minus current carrying value of financial liability, that is based on our amortization table, the whole divided by the current carrying amount of financial liability. If this difference, whatever, is more or equal to 10%, less than 10%. If it is more or equal to 10%, it means this is substantial modification. And if it is substantial modification, my dear students, extinguishment accounting will apply. Which accounting will apply? Extinguishment. If it is less than 10%, then modification accounting will apply. Extinguishment accounting means old liability removed, new liability brought. Of course, this new financial liability will be at present value of modified cash flows at new EIR. And this difference is to be in absolute terms. Don't think positive or negative. It is always absolute terms. Always use approach 1 if you are going with modification unless specified by the question. What should we do about transaction cost? My dear students, while finding out difference only, modified cash flows, we will consider the transaction cost in it itself. So transaction cost will be considered in it. So nothing to worry about. Now the third part, and that is nothing but partial derecognition of financial liability. Now, how can partial derecognition happen? I have sold debentures. I buy out the debentures from the market only. Our own debentures. We buy it from the market and we cancel off those debentures. That is nothing but partial derecognition. If an entity repurchases a part of financial liability, then allocate the carrying amount of financial liability between the part that continues to be recognized based on relative fair value of those parts. So the part which is derecognized, the difference will go to here. Okay, my dear students, so this is with respect to partial derecognition of a financial liability. Three things: full derecognition, modification, and partial derecognition.
After completing this partial derecognition of financial liability, the next area is debt for equity swap. Now here what is happening, friends? We are issuing our own equity instruments to the borrower on account of renegotiation. This is dealt by Appendix D in Ind AS 109. So if we are going to issue equity shares right from the beginning only to our borrowers, then though it is a compound financial instrument and something like that. But here we are going to issue our equity instruments on renegotiation. So it refers to issue of own equity instruments to the lender by the borrower on account of renegotiation. Now, how would you account for it? First part, liability is extinguished by issue of own shares, or the next part is the remaining liability. The liability which is extinguished with respect to issue of own shares and remaining liability. As far as remaining liability is concerned, again further two parts we can have. Continued without change or renegotiation. If liability is extinguished by issue of own shares, then friends, what are we supposed to do? Very simple. Our entry would be liability account debit, nothing but loan account debit, proportionate amount to equity share capital or security premium at fair value. Difference is nothing but loss or P&L. Profit and loss. Now, if it is continued, then no accounting. The remaining liability is continued as it is, no accounting is required. But if it is renegotiated, then we need to check whether it will be accounted as extinguishment or modification. Nothing but what we did previously, difference divided by the carrying value. If the difference is 10% or more, then of course that will be extinguishment of old liability and recognition of new liability. But if it is modification, there were two approach 1 and approach 2. So friends, this is very small area, date for equity swap, nothing but it is covered by our appendix D. Now my dear students, what was the next area we need to do? I think impairment. Derecognition of financial assets is done. Derecognition of financial liability, yes. Now we have impairment of financial asset. And then derivatives embedded in hedge accounting. Okay. Impairment of financial asset. See, this is not covered by Ind AS 36. If a financial asset is impaired, how that impairment should be accounted, it is what we are going to learn here. Our Ind AS 109 it is giving us 3-stage model for impairment. Remember, this impairment model does not apply to any financial asset which is carried at its fair value. Of course, a fair value through P&L. So if a financial asset is carried at fair value through P&L, the principles of Ind AS 109 impairment will not apply. Then remember, impairment testing is to be done if there is increase in credit risk. And ICI assumes that a payment remaining overdue beyond 30 days indicates increase in credit risk. Now for that they have given us expected credit loss approach. Now, as per this approach, now you have to create provision right from the initial recognition. It requires loss allowance to be recognized from initial recognition. Means we will not wait, but right from the beginning. Expected credit loss approach, also referred as ECL. And at each balance sheet date, the same have to be reassessed. At each balance sheet date, you have to reassess whether the loss is adequate or not. Now, how to find out expected credit loss allowance? So there are methods. 3 methods are there. Methods to calculate credit loss allowance. The first is nothing but loss rate method. Nothing but what is the percentage of default that is happening on particular types of loans. So from historical data, if I come to know there is a rate of 2%, then whenever such financial asset arises, I will create a loss allowance of 2%. Loss rate method, probability of default, and third, debtor aging schedule. Now, the question arises, which technique should be used when? So when you have some past experience, historical data, then loss rate methods will be the best. Like what is the default which has happened in the past? What is the total amount of the loans into 100, or you'll get percentage. And that too, you're not supposed to say 2%. So 2% all loans which are personal loan will create a loss allowance of 2%. No, if there is a loss, what is the LGD? What is the loss given default? That whenever default happens, what would be the amount of loss? I would be able to recover how much? 2% chances are there people default, but then I will recover it. Na? So how much I will not be able to recover? That is the amount. So basically, once we find out the rate, then whatever is the amount of our financial asset, multiply by that rate, loss rate, multiply by LGD, loss given default. Okay. So under loss rate method, the amount of provision will be nothing but the loan into loss rate into LGD, that is loss given default. Now, if it is probability of default, now this technique is to be used. When should I use this technique? Friends, when I don't have sufficient information for calculating the provision. Like in the past, we wouldn't have sold such type of loans. We are venturing into that market for the first time. So I don't have sufficient historical data based on which I can identify the amount of loss. So our standard says go for loss based on probability of default. What is probability of default? 2 parts. We can have 12-month probability of default or lifetime default. obviously lifetime probability of default will be more. The amount of default will be more. In case of 12-month POD, what we are doing? We are just thinking that if the debtor defaults within the next 12 months or the financial asset, the loan defaults within next 12 months, then what will be the loss? But when we say lifetime default, it means what? It means over the lifetime of that financial asset, if the default happens, then what? It means possibility of entity defaulting in contractually agreed cash flows over 12 months, that is 12-month POD. Lifetime POD means, it means possibility of entity defaulting over the entire lifetime of the financial asset and not just 12 months. Now, when should I use 12-month probability of default? When there is no risk. In case there is no increase in risk. Increase in credit risk. Lifetime POD will be more. Like, how much is your debtor? So I say my debtor is 1000 rupees, or not debtor. We can't go for debtor. You can go it. There is no harm. But I have given you a loan. What is the amount of loan? I say 1000. What is the chance that you will default? I say, sir, 1% chance is there you may default. So 1%. And what will be the loss given default? 25%. Assuming, these are just assumption figures. So I need to create provision of 1000 into 1% into 25%. Means the probability of default is 1%. If the person defaults, how much provision I should create? Okay. So this is our second technique, my dear students. The third is nothing but debtor's aging schedule. Here we create provision based on the age of the debtors. Means, what is the current due? What is due but not less than up to 30 days? 31 to 60, something like that. 60 to 120 or something more than 120. On each amount of debtors, I will have different provision. Obviously, as the debtor grows older, means it is due more, percentage will be higher. Say 5%, 3%, 2%, 1%, something like that. And this will be the amount of provision. Okay, so we have to go with ECL, expected credit loss. How to find out expected credit loss? It can be based on loss rate method, probability of default, and debtor's aging schedule. Now, dear students, what is this 3-stage model? I said in the beginning here only while teaching you impairment that the Indies gives 3-stage model. Now, what is that 3-stage model? Very simple. We just have to ask the question, and based on that, how much amount of impairment calculation will be dependent. The first question. Does the financial asset have significant credit risk on reporting date? Your answer may be no, or your answer may be yes. Next question. Has there been a significant increase in credit risk from the date of initial recognition? Your answer again can be no, and it can be yes also. If it is no, then the standard says you will go with stage 1, 12-month ECL. You will go with 12-month ECL. What is the expected loss, expected credit loss, provided the person defaults within 12 months? And the revenue is recognized on gross carrying amount. That is without deducting the loss provision. You should not deduct the loss provision, just whatever is the gross amount of our loans multiply by whatever is the interest rate. Moving further, does the entity have clear evidence of impairment? Again, your answer can be no, and answer can be yes. If it is no, then stage 2, lifetime ECL. Chance that you will default over your lifetime. And here, interest revenue, revenue means I'm talking about interest revenue. Interest revenue will be recognized on gross carrying amount. And if it is yes, so it is yes, then standard says stage 3, lifetime ECL. It is same only. Only difference is interest revenue will be recognized on net basis. Okay, dear friends, so this is all about our impairment. Now moving on to the next area, that is derivatives. What are derivatives? Nothing but derivatives are those contracts that derives its value from underlying a contract that derives its value from an underlying. That underlying can be a stock, it can be an index, it can be a currency, it can be a commodity. In order to fulfill the definition of derivative, friends, 3 conditions should be there. then only you are a derivative. What are the three conditions? First, response to changes of underlying. Response to the changes in underlying. No or negligible investment, initial investment. And third, it will be settled on net or gross basis. So then and then only we can say it is a derivative. Now the question arises, how should derivative be accounted for? This derivative can be a financial asset also, can be a financial liability also. And remember friends, in all cases, derivatives will be accounted at fair value through P&L, except that this derivative is not being used to hedge, or the derivatives to which hedge accounting is applied. If you remember, we were just revising everything. Financial asset, I said derivatives, equity instruments, others. In derivatives, it is always fair value through P&L. Same way, while financial liability also, derivatives fair value through P&L account. Now, what are the derivatives we can have? Those derivative financial instruments can be a forward contract, or a future contract, or a option contract, or a swap contract. Now these are my derivatives. Now when you enter into a transaction, at that point of time, we have to find out what is the fair value of the derivative at the point of entering into the transaction. My dear friends, remember, at the time of entering into the transaction, the fair value of derivative is always 0. So if I enter into a forward contract today, say I am going to buy dollars after 3 months. Today is say 1st of February 2022. I say I am going to buy dollars after 3 months. So I would be having something known as spot and forward. Spot rate is say 56, forward will be 58. Now the moment I enter into a transaction, there will be no journal entry passed, because remember, derivatives will always be accounted at fair value through P&L. Will always be accounted at fair value through profit and loss, unless hedge accounting applied. So if you don't apply hedge accounting, then it is fair value through P&L. Hedge accounting is a different area only. Now, this transaction what I was talking, 56 is the spot, 58. So you will enter into forward contract that I will buy dollars. Now my dear students, what should be the journal entry? So I just enter into a transaction, foreign currency receivable to rupees payable. At what value? 0 value. So why 0? The fair value of derivative on the date of entering into transaction is 0. Then comes say 31st March 22. Say the spot is 57 and this is trading at 58.80. And this is 3 month forward, whereas this is nothing but a 1 month forward rate. And on 30th April 22, this is 59. So what will I do is nothing but, when I have entered into forward contract, that no entry. So on 1/2/2022, no entry. On 31st March 22, don't you think I am gaining 80 paise? So it's a derivative asset. derivative asset debit to P&L. How much? 80 paise. Why asset? I am going to receive, that's why asset. Then on 30th of April 22, now it is 59. So 58.80 has become 59. So again 20 paise. So that is my asset. So derivative asset, because this is gain, that's why asset. It is loss, then I will say derivative liability. 0.20. And now if I go for net settlement, then what is the journal entry? If net settlement is there, then I will obviously get a value, bank account debit 1 rupees to derivative asset. But if it is not net settlement, it is gross settlement. It means I will be taking delivery. The entry will be different. This is for net settlement. If I go with gross settlement, if it is gross settlement, then foreign currency received, whatever foreign currency I have received, say $1. What is the worth of $1 today? So can I say $1 is 59? But how much am I supposed to pay? I am not supposed to pay 59 because I have entered into a forward contract. So I will not pay 59. I will pay how much? 58. To bank 58. To derivative asset 1 rupees. Both will not happen. It is OR. Same thing for futures, but futures they will be marked to market on daily basis because every day settlement happens. Futures and options. Forward everyday settlement not happens, so we bring it to market rates or we recognize the gain or loss at the balance sheet date, whereas if it is a future contract or option contract, we will recognize gain on loss on daily basis. So this is all about our derivatives, friends, not that challenging, simple stuff. Now going on to the next area, and that is embedded derivative. Nothing but separation. A contract which also has a standalone derivative. There is a host, and this host contract also includes, means the total contract has a host contract, and host is a non-derivative, and in that we have a derivative like convertible debentures. You say convertible debentures are compound. No, my dear students. Convertible debenture wherein the number of shares to be issued is not fixed. Because we used to divide it fixed to fixed rule. But if I say the debentures will be converted into variable number of shares, then it does not satisfy the definition of fixed to fixed, my friends. There comes embedded derivative. Now, what is an embedded derivative? The standard says an embedded derivative is a component of a hybrid contract that also includes a non-derivative host. Now, in case of embedded derivative, remember friends, we have to find out what is the fair value of the embedded derivative, and the balance will be fair value of host contract. If it was compound financial instrument, if you remember, in case of compound financial instruments, what we used to do is nothing but what are the proceeds received? From that we used to deduct fair value of liability component. So the balancing figure was nothing but fair value of equity component. Segregation is to happen in this way. But if it is embedded derivative, or I can say hybrid, financial instrument. If it is hybrid financial instruments, my dear students, then what we do is nothing but proceeds received. From that, I deduct fair value of embedded derivative. And whatever is left out is nothing but fair value of the host. Just for understanding, convertible debentures, wherein number of shares to be issued is based on market price on the date of conversion. In compound financial instrument, you have a single instrument, but I'll say I'll convert it into 20 equity shares. Fixed to fixed rule comes into picture, my dear. So compound financial instrument, it has both the features, equity and liability. Here you don't have both the features. There is no equity only. Here we have the host, which is a liability, and we have a derivative also. In case of embedded derivative, the economic characteristics and risk of conversion option are not closely related to the host financial liability. What are the examples, you'll say, sir? Nothing but convertible bond, or I can say a lease contract, wherein the variable payments are linked with market rates. Nothing but a forward contract to buy or sell goods in foreign currency. Now, what are we supposed to do? See, the standard says separation is required. Separation of host contract and embedded derivative. The host is a financial asset, or the host is a financial liability. In the underlying, if host is a financial asset, then standard is very clear: no separation required. the hybrid instrument is to be measured at fair value through profit and loss. But if the host is a financial liability, then the standard says separation is required provided following conditions are fulfilled. Now, what are the conditions? Nothing but the economic characteristics of the host contract are not closely related with embedded derivative. Economic characteristic of host are not closely related to embedded derivative. A separate instrument with the same term will meet the definition of derivative. Those three conditions of derivative, and the entire contract is not designated at fair value through P&L. Now, my friends, if these three conditions are fulfilled, then and then only we will go for separation. And remember the separation principle. We need to find out the fair value of embedded derivative. The balance will be the value of the host. That is the most underlying stuff. Now, to explain you this embedded derivative, I will take two examples. One is the prepayment option in a loan, and the other is nothing but we enter into a forward contract to sell or purchase goods on a future date in foreign currency. So the first special case in that, embedded derivative, prepayment option of loan. Now, what is this prepayment option? Like, I have taken a loan from you, then it's a liability for me, bank account debit to loan. But in this, I give you an option that you can prepay the loan. Now just think, friends, if I take a loan wherein you don't have a prepayment option, what would be the interest rate? And if I take a loan which has an prepayment option, what would be the interest rate? So that prepayment option is nothing but embedded in a loan contract is the embedded derivative. And the loan is the host. So now this prepayment option should be separated only and only if the economic characteristics are not closely related. Now, when can I say embedded derivative is to be separated from the host only if the economic characteristics are not closely related. Now, when can you say it is closely related? We can say that the economic characteristics are closely related if the prepayment price at each exercise date, means if you prepay, then how much you will pay. Prepayment price at each exercise date is approximately equal to amortized cost without prepayment option. Now, when can you say this amortized cost? And prepayment option. When can you say they are approximately equal to? And when you can say like 2%. I see there is nothing like 2%, even 1% can be there. Approximately equal not approximately equal. Now, if it is approximately equal, then it is closely related. If it is closely related, then friends, no separation required. I will directly pass an entry. You have taken a loan, bank account debit to loan. But not approximately equal to. It means they are not closely related. Which means separation is required. And if you go for separation, friends, then what should be your entry? Bank account debit, derivative, financial asset debit to loan. See, don't say asset, sir. You said in asset we don't separate, sir. This loan is the financial liability. This is having embedded derivative to loan, and this amount will be nothing but without prepayment option. This is what we will do. Now, approximately equal to is not given directly anywhere, but somewhere 2%. See, I am talking about 2% just because our ICI module, if you look at the illustration, they have taken 2%. So, nothing but difference. If the difference is 2% or more, then we say they are not approximately equal to. How to find out the difference? The prepayment price minus the amortized cost divided by the amortized cost into 100. Now, this difference percentage at any point of time, it's not necessary. at each exercise date is approximately equal to. So if this percentage is 2% or more, then we say they are not closely related and separation will be required. If it is less than 2%, less than or equal to 2%, less than or equal to 2%, I'm sorry for that. If it is less than or equal to 2%, then no separation is required. If it is more than 2%, then separation will be required. Now friends, moving on to the next area, special area within this embedded derivative. One was prepayment option of a loan. The second is nothing but foreign currency derivative embedded in purchase or sale contract. Again, here we have to identify whether separation is required or not. See, this procedure, separation will be required and all those things only if they are not closely related. Now, when can we say? In this case, see, there are two. The underlying host contract is purchase of goods or sale of goods, and the derivative embedded in it is nothing but forward contract, forward sale. If I say purchase of goods is there, I'm going to purchase goods from you. It means I've entered into a derivative to sell foreign currency. I say I'm going to sell goods to you. Then don't you think there is a forward contract which is nothing but purchase dollar, purchase foreign currency? Embedded derivative and host contract are considered to be closely related if transaction is denominated in functional currency to any party to the contract. Second, transaction is denominated in a currency that is routinely used, for example, for crude purchases, or the transaction is denominated in a currency that is routinely used in the economic environment of the country. I can just give you an example. ABC and DEF, both of them are in our country, Bharat, and they enter into a contract wherein ABC says, I will sell you goods after 2 months for $5,000. So ABC and DF both are having functional currency rupees. They enter into a contract to buy. One for 1% is buy, other is sale, and that too in foreign currency. Okay, so just for your understanding, I'll just write it down. What we do is nothing but we present it in this way. Like say we are an entity and we are going to purchase goods. So the host is nothing but purchase of goods, and the derivative, which is nothing but forward sale of foreign currency, say dollar. But if the entity enters into sale goods and received in dollars, so nothing but the host is what? Sale of goods, and the derivative is nothing but forward purchase, that too in dollar. Now, what are the accounting treatment? I'll quickly revise all those things. See, after reading the question, you should be able to understand whether underlying is purchase of goods or sale of goods, because the stuff would be different for both the parties. What is forward purchase of goods is sale for you. The underlying purchase or sale should be measured at forward rate. Prevailing on the date of order. The actual purchase sale will be in accordance with Ind AS 115. At a later date. The embedded derivative. What is that embedded derivative? Sir, forward sale of dollar, forward purchase of dollar. That is nothing but foreign currency. Should be measured using fair value through P&L. Of course, fair value through P&L, it is derivative. So, initial recognition, it will always be 0. So, derivative asset to derivative liability 0. Forward sale or purchase of foreign currency should be measured using fair value through P&L. On initial measurement, the fair value of derivative is 0. Third, on the date of settlement, the purchase and sale will be recorded at forward rate, nothing but the predetermined price. Derivative would be remeasured and settled. Means whatever is the balance in your derivative asset or derivative liability will be adjusted against debtors and creditors. Balance in derivative asset or liability will be adjusted against debtors and creditors balance. Okay, so my dear friends, this is all about your embedded derivative. Of course, a very important topic. You need to again revise it. Whatever notes are there in that, you have to look at the examples what we have done for this topic. Other topics, what happens? you are always having a grip of it. Embedded derivative, revise it twice if possible. Now friends, moving on to another area. What was the last stuff left out? If you look properly, impairment done, derivative accounting, embedded derivative, yes, hedge accounting. See, basically there is no direct question with respect to hedge in our module, but once in RTP they're given. So it is always advisable to revise the stuff, hedge accounting. The last area in our financial instruments part 2, hedge accounting. Now say friends, we are having investment in equity shares that is measured through OCI. Now we are having a risk of changes in the value of that equity instruments. So what we do is nothing but we enter into a contract, say a derivative, a put option. Now what is going to happen? This is a derivative. So the changes in this derivative will be captured through profit and loss account, whereas my equity instrument is at fair value through OCI. Don't you think this creates mismatch? Now what is this hedge accounting? First of all, it is an optional accounting. It's not compulsory. Hedge accounting is an optional accounting treatment under Ind AS 109. It eliminates the mismatch. With respect to changes in hedged item and hedging instrument. Now what is an hedged item? The item which gives me risk is the hedged item. Something which is giving us a risk, like an asset or a liability. Accounts receivable, investment in equity shares, foreign currency loan, floating rate loan, which I have given in our currency, say rupees, an asset or liability. These are all giving me risk. An unrecognized firm commitment, nothing but commitment to purchase the goods or sell the goods at a later date, or a highly probable forecast transaction. What else? Net investment in foreign operation. These are the hedged items. Means these are the items which are going to give me risk. And how would I eliminate this risk? So obviously, I will use some instruments which are referred as hedging instrument. Now this hedging instrument can be two. Either derivatives which are measured at fair value through P&L, on non-derivative financial asset or financial liability which is measured at fair value through P&L. These are the items, like I have investment in equity shares, so I may enter into a future contract or a forward or an option, put option obviously. So what happens friends? I am trying to reduce the risk of changes in the fair value of my equity shares by entering into an option or a future. So that is nothing but referred as that contract of future, the contract of option is referred as hedging instrument, and the equity share which is giving me risk is referred as hedged item. Now my dear students, what can be the hedging relationship? Of course, there is a qualifying criteria and all those things. I'm not going into those areas, but the major chunk. What can be hedging relationships? Means how many types of hedging can we enter into? The standard classifies the hedging relationship as fair value hedge, cash flow hedge, and hedge of a net investment in a foreign operation. Now when I'm talking about fair value hedge, what is a fair value hedge? And we'll also learn the accounting with respect to it. The risk which is being hedged is the changes in fair value of a recognized risk that is hedged is the changes in the fair value of a recognized asset or liability or an unrecognized firm commitment. Changes in fair value. My fair value would change with respect to that particular asset. Equity shares, I bought at 100, fair value may go down to 80 rupees. So the changes in fair value of a recognized asset or liability, that is getting hedged. So we say it is nothing but fair value hedge. Now the accounting treatment, very simple. What does the standard say? It says there are two things. Hedged item and hedging instrument. So if the changes in the fair value of the hedged items are routed through profit and loss account, then the changes in the fair value of the hedging instrument will also be routed through profit and loss account. But there is an exception to it. In case of investment in equity shares, where we have taken the irrevocable option to classify it at fair value through OCI, so if the hedged item fair value changes are routed through OCI, then the hedging instrument fair value changes will also be routed through OCI. Now what is basically happening is nothing but we are just eliminating the mismatch. Now coming on to second relationship. That is cash flow hedge. What is being hedged is nothing but variability in cash flows. The risk that is being hedged is the exposure to variability in cash flows. And this variability in cash flows risk is arising on account of a recognized asset or a liability or an unrecognized firm commitment recognize asset or a liability or a highly forecast transaction. Now, how should you account for cash flow hedge? See, in case of cash flow hedge, the portion of the gain or loss on the hedging instrument it is determined to be an effective portion, or you can say effective hedge, that goes to OCI. Nothing but we will have cash flow hedge reserve, CHFR, and the ineffective portion of our hedged item that will be recognized through profit and loss account. Now we have fair value hedge, then hedge of a net investment in foreign operation. Nothing but we want to hedge our interest in the foreign operation. So now what is my interest? Nothing but the assets minus liability in that foreign operation, and that foreign operations functional currency is not same as my currency. Then only we say it is a foreign operation. So obviously we are going to translate and all those things. So what we are hedging? We are not hedging a particular asset or liability, but we are going to hedge the net interest which we have in that particular foreign operations. Now, accounting treatment of a hedge of a net investment in foreign operation is very much similar to our cash flow hedge. The portion of, means whatever is the hedged instrument, whatever portion is effective hedge, that will be recognized and accumulated under OCI, and the portion which is ineffective portion will be recognized through P&L. So my dear students, this is all about your hedge accounting, and basically end to Ind AS 109 part 2. Let us move forward with another Ind AS, and that is Ind AS 21. Some important points, nothing but definition, foreign currency transaction, foreign operations, appendix B, and first time adoption. Now friends, as far as Ind AS 21, the effects of changes in foreign exchange rates. Now the most important vital part is nothing but what is presentation currency, what is functional currency, and what is our foreign currency. Okay, so under definition, that only decides. The first definition is with respect to presentation currency. What is your presentation currency? So the index says the currency in which financial statements are prepared. The currency in which financial statements are prepared is nothing but a presentation currency. That is basic. Now the most important from this standard perspective is functional currency. Now what is functional currency, friends? It says it is the currency of the primary economic environment in which the entity operates. The currency of the primary economic environment in which the entity operates. This is nothing but your presentation currency. Now the point comes, sir, what is primary economic environment? Nothing but primary economic environment is the economic environment in which the entity primarily generates and expends cash. Now friends, it may happen that a company is registered in our country only, but the functional currency may not be Indian rupees. That is possible because of this definition. Functional currency is the currency in which you are supposed to prepare your financial statements. So it's quite possible that a company which is registered in our country did not prepare its financial statements in rupees. It may be exposed to an economic environment which is not our country. So that is functional currency. And now for that they have given us indicators. What are the indicators to identify functional currency? So number one, these are primary indicators. The currency which influences the selling price of goods and services. Means the sales are denominated in that currency and settled also in that currency. The currency of the country based on whose market forces and regulation selling price of goods and services are determined. And the last, so the market forces of say Japan decides the selling price of my goods and services. I may invoice the goods in yen and the settlement also happens in yen. The currency which influences the labor, material and other costs of providing goods and services. See, these are the factors. Out of these three factors, it may happen that we have rupees here, but dollar here and dollar here. Then the dominating is dollar. So dollar will become my functional currency and vice versa. Standard says, okay, you may go with this, but there are other indicators also, or I can say secondary indicator, which may give me supportive evidence with respect to the primary indicator. Like the currency in which financing activities takes place. And the currency in which receipts from operating activity that is nothing but our secondary. These are just illustrative. You should always focus on primary indicators. Now, what is foreign currency then? Other than functional currency, all currencies are foreign currency. So it may happen that a company is registered in our country, Bharat, has functional currency which is US dollars. So for them, Indian rupees will be foreign currency. That is possible because of the definition. Okay. So my dear friends, this was all about our definition part. Now coming on to foreign currency transaction. What does the standard say? If you enter into any foreign currency transaction, what are we supposed to do? It says initial recognition. This initial recognition should happen at the exchange rate on the date of transaction. Whatever is the exchange rate, that rate becomes our measurement criteria. And thereafterwards, my dear friends, what are we supposed to do? The index says if it is settled, the difference between the initial recognition rate and settlement rate should be recognized as exchange fluctuation, gain or loss. But if the particular item is carried forward in the next year, then we have to translate that item, that is referred as subsequent recognition. Using exchange rate on the date of balance sheet. So you can have foreign currency transaction, you have to recognize it at initial rate and then you have to translate it. Now this will give rise to currency fluctuations. These currency fluctuations can be because of what reasons? Different between initial recognition rate and settlement rate, or it is difference between initial recognition rate and translation rate. Translation is nothing but at the balance sheet date we have to translate the items at closing rate, or I can say difference between subsequent recognition rate, that is I can say translation rate better, and settlement rate. And one more you can add, difference between the translation rate and subsequent translation rate. So my friends, this is how currency fluctuations will be arising. Now the point comes, we should recognize this currency fluctuation on what? So my dear students, currency fluctuation should be recognized on monetary items. Now what are monetary items? Monetary items are items of cash, assets to be received, and liabilities to be settled in fixed or determinable amount of units of currency. These are monetary items. For example, debtors, creditors, loans, bill receivable, bills payable. These are all my monetary items. And what is non-monetary items? Other than monetary item, like inventory, PPE, investment in equity shares, provision for warranties. These are all non-monetary items. Now what does our standard say? The standard says that how should we account for exchange fluctuation? Understand here. These exchange fluctuations will be accounted with respect to monetary items and non-monetary items. Non-monetary items, two parts. Measured at historical cost measured at fair value. If it is monetary items, then will be measured using exchange rate on the date of balance sheet and currency rate fluctuations will impact it. So monetary items will increase, like my debtors, creditors. On balance sheet date, I will be measuring it at the rate on the date of balance sheet. I sold goods of $1,000 on January. On 31st March, $1,000 will be brought at closing rate. So monetary items. Historical items, no remeasurement. Means non-monetary items like PP and all these things. So there is no need of remeasurement. But if a non-monetary item is measured at its fair value, then it is measured using exchange rate on the date of balance sheet. And currency rate fluctuations will affect it. Will affect it. Like I have an inventory, but the inventory is in foreign country. So we say, sir, I am holding that inventory in foreign country. It should be valued at cost or NRV. See, if it is cost, then there is no problem. But if it is valued in NRV, because NRV is less, then don't you think it is fair value? The NRV is getting determined in foreign currency. What will I do? Whatever is the NRV in foreign currency, multiply by closing rate. So exchange fluctuation are impacting non-monetary items. Similarly, an item of PPE. If I am following cost model, there is no issues. But if I am following revaluation model, then what will happen, my dear students? Don't you think that revaluation model is there? Then it will always be at fair value. And I am having that item of PPE at a foreign location. So the fair value will be determined in foreign currency. I have a crane at a particular port in Sri Lanka. So the crane, if I want to find out fair value, the fair value has to be based on the market where it is. That fair value will be in foreign currency, multiply by exchange rate. So exchange fluctuations are obviously going to affect non-monetary items. Now, normally, what is the thumb rule? Remember, all exchange fluctuations are recognized through profit and loss. All exchange fluctuations are recognized through profit and loss. Thumb rule. Only one exception. PP that is measured using revaluation model. Sorry. PP that is measured using revaluation model. Like I have a PP in Sri Lanka. I am going for fair value. So now what will happen? I will go with revaluation model. I will find out the fair value. Fair value is in foreign currency. That foreign currency multiply by the currency rate on the date of balance sheet. So what is happening? My fair value changes are inclusive of two things. Now, one, the actual change in the value of the PPE, and other is nothing but exchange fluctuation. So in that case, it goes through OCI. Okay, this is the only exception available. This is with respect to, friends, foreign currency transaction. Now moving on to another area, and that is foreign operation, foreign currency transaction. Now let us move on to foreign operation. Now friends, the next area what we are discussing is about foreign operation. What is a foreign operation? The standard says a foreign operation is a branch, subsidiary, associate, or a joint venture, and the functional currency of that operation is other than functional currency of the reporting entity. An operation that is a branch, associate, subsidiary, or joint venture whose functional currency is other than functional currency of the reporting entity. An operation that is a branch, associate, subsidiary, joint venture whose functional currency is other than functional currency of reporting entity. Now friends, it may happen that I am a reporting entity in our country Bharat, and I may have a subsidiary in Bharat only, but the economic environment in which that subsidiary is operating is not Bharat. So it may have its functional currency different. So though parent and subsidiary both are in one country, the subsidiary entity becomes our foreign operation. And it may happen the other way out. I am having a subsidiary in the Middle East, but the economic environment is of our country only. So it may happen that the subsidiary will prepare its financial statements in the rupees. So if an operations functional currency and my functional currency are same, then the question of translating does not come. It is normal subsidiary, irrespective of where the operation is domiciled. It may be in any part of this world. But if its functional currency is same, my functional currency, no translation is required. But translation is required when your operating currency, your functional currency, the operation functional currency and my functional currency are different. Now, generally, when the operation is dependent on the reporting entity for resources, some funds requirement, and does not have high degree of autonomy, then the operations functional currency will be same as of reporting entity. Then there is no need of translation. But when your functional currency and my functional currency are not same, then friends, translation comes. So if functional currency of the operation is different, then the functional currency of reporting entity we need to do translation of its financial statements of foreign operation. Now for translation, the standard has given out this way: monetary items, they have to be translated, converted using closing exchange rate. Non-monetary items translated using closing exchange rate. Monetary items may be assets, liabilities, non-monetary items also assets, liabilities. Income, expense, loss, gains, they will be translated using actual exchange rate. For convenience, average rate. For convenience, we use average rate. Now, when we are translating, see, monetary item, non, this is basically trial balance, and the trial balance will be translated. That's why we have income, expense, loss and gain. So there will be a difference because some items are going at historic, some items are going at closing exchange rate and one is going at average rate. Yes, one more point, because you have done consolidation. Equity share capital and pre-reserves, this both are translated using rate on the date of acquisition, the day we acquire the business, on that date. Now resulting difference, there will be some difference. It is accumulated under FCTR through OCI. That is nothing but foreign currency translation reserve. And this is how that accumulation happens, and it is shown under our other equity. When we dispose of this foreign operation, my friends, then the balance tending to the credit or debit of FCTR, because FCTR can have debit balance, exchange losses have been accumulated, or credit balance if exchange gain are there, then that amount would be reclassified to PL only on disposal of foreign operation, that FCTR, because it is a reclassifiable item. Now moving on to the appendix. Now what is this appendix B to Ind AS 21? Friends, it deals with advance. If you have received an advance, say for example, I received an advance on 1st of January 2023, advance received or advance paid, and the related transaction happens on, say, 15th March 2023, transaction is done. When I received advance, let's say $1 is 60 rupees, and when the transaction is happening, $1 is, say, 62. So at what rate should this transaction be recognized? This is what appendix B deals with. I'll make it simple. I'll make a small example. Advance received for sale of goods 10,000, on 1st February 2023. Sales made on 15th March 2023. Of total value of $18,000. Of course on credit as of now. Exchange rate, say on 1st of Feb, $1 is 60, and 15th of March, $1 is 62. So my dear students, a question arises, how should this advance be accounted for? This is dealt by Ind AS B. It is dealt by Appendix B to Ind AS 21. Now what does it say? It says, as far as exchange rate on the date of the transaction is concerned, to the extent of the advance received, the rate on the date of receipt of advance will be treated as the exchange rate. Means, in this case, friends, my entry would be bank account debit to advance from customer on 1st February 23, $10,000 into rupees 60, nothing but 6 lakhs. And now when I am selling the goods, the total value of the goods sold is 18,000. So we will be having sales. So when are the goods sold? 15th March. So on 15th March 2023, what should be the journal entry? You will say, sir, very simple. Advance from customer, debit. How much is the advance from customer debit? 6 lakhs. to sales. How much should be my sales? My sales should be nothing but, as far as $10,000 is concerned, I will multiply by 60 plus, as far as $8,000 is concerned, I will multiply by 62, and here my debtors will be there because I have to receive money, debtors account debit, 4,96,000, which gives me 10,96,000. So dear students, this is what the standards say. This sales is getting recognized with respect to this, though the transaction date for the sales is 15 March. Normally what we say, if the transaction date is 15 March, whatever is the rate, we should recognize it at that rate. No. But if we have received an advance, or if we have given an advance, then the related asset or expense or income will be recognized using the rate on the date of receipt of advance. This is what our appendix B deals with. Okay. Now moving on to the last area. First time adoption of Ind AS 21. Now friends, when you go for first time adoption of Ind AS 21, how does it move? I need to give you an idea with respect to a small area, which is para 46A of AS 11. In first time adoption, this is the only important area which you should remember. As per para 46A of AS 11, exchange fluctuations on a long term monetary item. Long term means something which was more than 12 months. Exchange fluctuation on a long term monetary item, that is in relation to depreciable fixed asset, or that is in relation to others. Then in this case, exchange fluctuations are capitalized, and here exchange fluctuations are transferred to foreign currency monetary item translation difference account and amortized. This is what happens. First time adoption, para 46A of AS 11. This is what optional accounting treatment was there. This was optional, means as per AS 11 everything will go to P&L, exchange fluctuation. But if you adopt para 46A of AS 11, then that para 46A is to give us an alternative accounting treatment wherein we can capitalize the exchange fluctuations. If it is loss, we will add to the fixed asset. If it is gain, we will reduce it from the fixed asset. But if this long term item, like normally long term item is nothing but loan, I have taken a loan for fixed asset, then whatever exchange fluctuation happens on that foreign currency loan will be added to the fixed asset or reduced from the fixed asset. But if I have taken a loan for some other purpose, means not for a depreciable fixed asset, but say working capital or to repay an existing loan, then whatever exchange fluctuation arises on that long term loan will be transferred to another account known as FCMITDA, foreign currency monetary item translation difference account, and it will be amortized. Clear? Now the problem comes is you are going with para 46A. As per AS 11, you have selected that option. This option was given by MCA. Now if we switch over to Ind AS, then what to do? So what does our Ind AS first time adoption says? that all those long-term monetary items for which option under para 46A existing long-term monetary items for which option under para 46A was exercised, then under Ind AS 21 the entity can continue using that option for that long-term monetary item. Okay, so the entity can continue using that option. But remember friends, once you adopt Ind AS 21, you say I have a long-term monetary item, I would like to continue. But any long-term monetary item which arises after the date of adoption of Ind AS, for that para 46A cannot be used. Only for existing long-term monetary item, para 46A can be used. Clear, my dear friends? Okay, so this is all about our Ind AS 21. We have quickly revised all the concepts, important concepts of Ind AS 21. Let us move on to another standard. Okay, so let us go with one more standard. A very small standard, but it has been asked many times in the exam, and you will be happy to know that the questions which have been asked are the same questions which are there in the module also, and the same have been done in our JK Shah class also, lectures. Agriculture. Some important points of agriculture. You need to remember the applicability of this standard, where it does not apply. Certain terms recognition and measurement, and the last area government grants. Now friends, basically this standard prescribes the accounting treatment and disclosure relating to agriculture activity. Okay, so first of all, applies to or applicability. This standard applies to what? Number one, biological assets. Nothing but living animals and living plants, of course, except bearer plants. Why? Because bearer plants are covered by Ind AS 16. It applies to agriculture produce at the point of harvest. And number three, government grants that are related to biological asset other than bearer plants, because the government grant which are related to bearer plants are covered by Ind AS 20. But it does not apply to, means the principles of this standard will not be applicable for land related to agriculture activity. Government grant related to bearer plant. Intangible asset related to agriculture activity. And the last, right of use of asset arising from lease of land related to agriculture. Now this is the applicability of our Ind AS. Now coming on to definition. Quickly, we'll define some important areas like many things you know. Biological asset, living animals and plants. But this Ind AS will not apply to bearer plants. And bearer plant, nothing but bearer plant is a plant which is held. This is given under Ind AS 16. It is held for production or supply of agriculture produce. It is going to bear a produce, and there is a remote likelihood of it being sold as an agriculture produce, like mango tree, coconut tree. These are all bearer plants. I'm not talking about trees in our commercial places or something like that, which are grown for the purpose of scenic beauty and all those things. Nothing but business activities. I'm having my farm wherein I have grown coconut trees. So this coconut tree is a bearer plant. But the coconut on that plant will be covered by Ind AS 41 because it is agriculture produce. So this agriculture produce. What is agriculture produce? It is not related only to plants, but it says it is harvested product from what? Biological asset. Harvested product from biological asset like cow, milk, sheep, wool, coconut tree, coconut, the tea bushes, then the picked leaves. This is nothing but agriculture produce. Then what do you mean by harvest? It is detachment of produce from biological asset or end of the biological asset life process. And this standard applies to agriculture activity. Like you go for sea farming. Like we are going to catch fish from sea. This is not covered by Ind AS 41 because it is not biological transformation of biological assets. You are going to manage an activity which is biological transformation of biological assets for sale into agriculture produce or into additional biological assets. That is agriculture activity. But fish farming which happens there, that will be covered. We go in the forest and we remove the honey. That is not agriculture activity covered by these Ind AS. But if we have honey farms, then that becomes agriculture activity because the word used by the standard is management by the entity of the biological transformation of biological assets. Okay, so that is harvest. Now comes recognition and measurement. How things should go for recognition and measurement of Recognition criteria is simple. When should we recognize? Those it should give us future economic benefit. Yes or no? We control it, and fair value is determinable. It will result into future economic benefits. I control the asset. Control means I can restrict others the access to it. And fair value is determinable. Now friends comes measurement. Very, very important. Remember, biological asset and agriculture produce are measured initially and subsequently at fair value less cost to sell. Fair value less cost to sell. Initial measurement means the day we measure that biological asset, it will be at fair value less cost to sell. Fair value. What is fair value? 113 says fair value is the price that will be received on sale of asset or paid to transfer a liability in an orderly transaction between market participants on a given measurement date. That is fair value. Nothing but market prices between two participants. Less cost to sell. Now what is cost to sell? Cost to sell are those incremental costs that will be incurred to sell that particular product, agricultural produce or biological asset. See, fair value is always inclusive of transportation cost. I have to take it to the market, then only I get the fair value. So transportation cost is not incremental cost. If I sell, then this cost will be there. The commission I may pay. These are incremental cost. And those changes which happens between the fair value from one recognition date to another recognition date, these fair value changes are recognized through P&L. Now agriculture produce at the point of harvest will be measured at fair value less cost to sell under Ind AS 41. Once it is harvested, it becomes inventory, and whatever is the fair value less cost to sell of that particular item becomes the cost for Ind AS 2. Like you have mangoes on the mango tree. Now at the point of harvest, these mangoes will be measured at fair value less cost to sell, and the principles of 41 will come into picture. But the moment those mangoes have been harvested and kept in those boxes for sale, they will be now referred as inventory, and the principles of Ind AS 2 will apply. Cost or NRV, whichever is lower. What will be the cost for those mangoes? The cost for these mangoes will be nothing but whatever fair value less cost to sell was determined for that agriculture produce. Okay, so measurement is there. There is one exception for biological asset. Can be measured using cost model. Only for biological asset is there, huh? Only if the entity proves that quoted market prices are unavailable and alternate measurement bases are unrealistic. Now moving on to the last area of this standard, and that is government grant. Now, as far as government grant is concerned, relating to biological asset. Friends, I will break it into two parts. Biological asset. It is measured at fair value or measured at cost. Now, if it is measured at cost, then government grant received will be accounted as per India's 20. Nothing but capital approach and revenue approach. You receive the grant, so you will reduce it from the cost of the asset. But if there are some future conditions, then you will accumulate the grant under deferred government grant account, and the balance in deferred government grant account will be amortized over a period. If you are going with cost model, biological asset is at cost model, then India's 20 will apply. But if it is measured at fair value, then the next question we should ask is the government grant conditional? You may have two answers. Yes, I need to fulfill the condition, then only I will receive the grant. No, sir. No conditions are to be fulfilled. If conditions are there, friends, then recognize government grant to profit and loss only when conditions are met. But if it is not conditional, then recognize government grant to profit and loss when it becomes receivable. Okay, so friends, if you look properly, a very small standard but very important standard. For examination point of view, it has been now asked on 5 occasions. You may just also refer to strategy to clear CA final, which has been shared on our Telegram channel of JK Shah classes also, where we have done ABC analysis, A category chapters, B category chapters and C category chapters. Obviously, I am revising those chapters which we feel should be done at the last moment. Of course, all chapters are important, but some chapters have too much of weightage, so repeating it again and again obviously gets an edge. So friends, this much from my side. Thanks a lot. All the very best. God bless. Thank you.